you know what, I can't do this, I can't do that, because, you know, what is it, the Justice Department's going to come after him? Their mothers? I mean, they got to think a little bigger. I keep emphasizing think big when I speak to them. Think big, think big. Right. And when they think small, Carl, I just want to wring their necks, because they're just better than that.
As Fauci said over the weekend, if you think you're overreacting, you're probably doing enough, or maybe not quite enough. But it's going to feel like you're overreacting.
Right, and that's what I think Secretary Mnuchin really understands that, and they're not going to play the nicety game of, you know what, I'm very concerned about that because someone might come after me, because there is no someone. There is no someone. There is no federal cop on the beat who says, Secretary Mnuchin, you violated the law. I mean, yes, there are issues involving amendment, the 11th Amendment, the some states' rights issue. But in general, I think they're ready to figure out, you know what, we're not going to use the law as a reason not to help people. We're going to use the law as a reason to help people.
So this morning, you mentioned you're watching oil. We're back above 29. Do you believe that if the Fed's true mission on Sunday night, corporate spreads, and they do in fact narrow, that equities would follow?
No, not at all. I mean, I don't think that they're thinking about equities. No, I know they're not thinking about equities. I think they feel that equities will take care of themselves. As long as they keep the market open, people can sell because they need the money. But when it's over, there'll be opportunities. But they'll talk about it. I mean, in 2007 to 2009, in that administration, they always rebelled when I talked about stocks, because stocks were for rich people. This administration doesn't feel like that. They're worried about the working person, including the working person who has savings in stocks. They don't have the contempt for entities that are just on the everyday side of doing business. And they're not thinking that, you know what, this entity needs to be punished. That was so often the narrative. I remember the morning of Lehman, when they were telling me, we got to punish Lehman. That was an interesting and quaint notion, right? And we look back and, like, do we love them for punishing Lehman? Is that what we remember them for? No, we think they were idiots for punishing Lehman. Because in retrospect, it wasn't like that. You ended up punishing thousands of people who didn't do anything wrong. And this administration, or Secretary Mnuchin, is thinking about that. And I find that somewhat reassuring. It doesn't make me want to go and say, you know what, Procter, at 72, I'm salivating. Kind of.
Well, that brings me up to the other topic this morning, Jim, which is the slew of upgrades. And I don't mean to, I know this doesn't sound appropriate given the moment.
Right.
But today, upgrades of CAT, Clorox, Las Vegas Sands, Verizon, Domino's, eBay, Altria, USB, Costco. Some of them make sense. But is this the time to be reading those?
Early. They're early. I read through all of those. Started the morning early like you did, Carl. And I'm thinking, well, now's the time to, you know, to make a big bet. I mean, like, some of these guys were actually even upgrading oil companies. I didn't see a single upgrade that I thought made any sense whatsoever. As a matter of fact, the opposite. I said, well, you keep your powder dry. You don't know whether we're going to be, you don't know how much we're going to be down today. I mean, is today the day we're down 13? Is today the day we're going to be down 20? Why not wait and see? I mean, I'll give you an example. And I don't mean to pick on Jeffries, but let me pick on Jeffries.
This is Las Vegas Sands.
Yeah, no, Las Vegas Sands. Who's the full faith and credit of what there? Sheldon Adelson? I mean, full faith. You got to be full faith and credit of these companies. No, of Caterpillar. I like Caterpillar. They're a good company. If they trade to some level where it's an accidental high yield, that's fine. I don't want to buy a single company where the numbers are too high. And Carl, with the exception of Clorox, I did not see a company where the numbers may be, the estimates are reasonable. I think they're all too high except for Clorox, where they could go higher. I'm raising numbers Clorox.
The Jeffries call on Las Vegas Sands, the title of the report is Safe to Play in Traffic. And their point is, of the companies we follow, we have the clearest view of LVS 2 to 3 years out.
Yeah.
So the duration of patience is remarkable.
Well, look, I mean, they're obviously more patient than the people who own the stock. Look, I think that what you have to think about, you can think 2 to 3 quarters out. When I'm looking at our companies that say, if they go down a great deal, but you still need their product, that's an opportunity. Let's take Verizon, because it's neutral. Do I think that Verizon's a buy? At a certain level, yes, because they're in the mix of things that you have to have. Do I think that certain department stores are essential? No. Do I think casinos are essential? No. So do I think Carnival Cruise is essential? No. They may want to be able to keep these companies alive, but I don't think that means they want to insure the common stocks. I don't hear anything about that.
Yeah. Finally, Goldman's David Kostin. A combination of tools suggests S&P trough at 2,000, which is down 26 from here, down 41 from the high. We still expect year-end 3,200, which would be up 18 from here. How in the world are these guys coming up with calls like this? We love David, but we're talking massive assumptions, aren't we?
I was joking with David. I so much love the front call. Because I think that that's a reasonable expectation. I had thought that we would take out the December 2018 low, which was the one that we briefly touched on that in the pre-market on Friday. Remember, December 18 was a time of great crisis because that was Jay Powell kind of really doing a little too much there on the tightening side. But no, the other side, I was saying to David, look, there's no need to it. I mean, when I speak to the Treasury Secretary, we don't have to speculate where we're going to be. When we beat this thing. When we beat this thing, there will be a tremendous amount of pent-up demand. So when you sell here, what you're betting is we're not going to reopen anytime soon, and these companies are going to lose. I just want to be careful. I look at companies and say, who's essential and who's not? And I think a lot of us went over the S&P this weekend. Is Occidental, do we need Occidental, which is obviously the poster boy for lunacy here? No. I mean, do we need Gap stores? No. Do we need Wells Fargo? Yes. I mean, you go down and you look at the yields and you say, well, which ones are the ones that we absolutely need? And then you say, okay, well, who's got the most steady? And I would come back with Altria and Clorox, and maybe I like Procter. I really do. I like the consumer product companies because you need them, and because when you go to the supermarket, you see a lot of Campbell Soup and Kellogg being bought. So, I mean, I spent a lot of time at the supermarkets this weekend just to see what people were taking. They're not booking cruise ships there, but they are taking a lot of soup cans.
People should, I just want to remind our viewers, Jim has been cautious since Super Bowl Sunday. It's nice, Jim, that we can actually go back and trace the date, because that's when you talked to Tepper in Miami. And your views have a lot of credibility going into the chapter we are entering.
I remember discussing with David. I said, well, you know, look, things are so bad. I guess I can't go to the game. I got to go back. And he said, yeah. So I left. I didn't see the game. I brought back the tape. It was kind of, there's a little Pyrrhic down there. Go down there, interview Tepper, and then get on a plane back. It looked like a good game. Andy Reid, congratulations. But yeah, I mean, I've been so nervous since then. I'm not saying I'm not nervous now. I am saying that when things happen that you expect, you can't suddenly say, you know what, I'm scared to death. Instead, what you're saying is, okay, I'm going to try to stay healthy. I'm going to go home and kiss my wife, try to relax, read some research, go back to work. Just hopefully when I kiss her, she doesn't have it, I don't have it.
No, look, Jim, we all had our temperature taken when we entered the NYSE today. That's the new normal, and it does help you understand the guardrails we're going to have to put up, at every corner of our life.
I had my wife, I had one of those weird things in your head. It was better than a rectal, but I mean, you know, I like the ones that go on here. But I had the one on the head, and she's doing this, and every 4 hours, she goes, Jim, if I'm going to have to do this the rest of my life every 4 hours, forget it. We're going to be in different places. So I said, you know what? Maybe I'll wait till I'm hot. She goes, well, that would be a practical thing to do. Can we also be practical? I like the idea that we want to protect ourselves from others, and I think it's absolutely great what the exchange is doing. But she regarded my let's take my temperature every 4 hours as a sign of panic. I've come around to thinking she's right.
Not a strategy, as we always say. Jim, let's check in with Kate Rogers at HQ, get the latest on the coronavirus today. Morning, Kate.
Hi, good morning, Carl. Confirmed cases topping 169,300 worldwide, with more than 6,500 deaths. Europe is now the center of the pandemic. In Italy, hardest hit outside of China, officials on Sunday reporting the number of deaths jumped 25% over the prior day. That's the biggest uptick of any country we've seen yet. The number of deaths there now at 1,809. The U.S. has added the U.K. and Ireland to its European travel ban, and the CDC recommending the cancellation of any events with more than 50 people for the next 8 weeks. State and local officials issuing new restrictions aimed at curbing the spread of the virus. Schools have closed in 33 states, California, Ohio, Massachusetts, and New York City, also closing bars and restaurants. America's top infectious disease official, Anthony Fauci, urging Americans to stay home, saying that new guidelines on curfews and social distancing will come later today, warning of a spike in deaths if behavior does not change. The White House's coronavirus task force is promising a major increase in the availability of testing this week, rolling out 1.9 million tests to 2,000 sites. An increase in confirmed U.S. cases now at more than 3,700, and deaths at 69 is expected. For much more on this, check out CNBC.com. They have a live coronavirus blog that's been fantastic, and they will continue to update as we move ahead, guys. Back over to you.
All right, Kate, thank you for that. Jim, I do want to turn to you on some Regeneron headlines this morning. Working with Sanofi on a trial for severe COVID-19. The U.S. trial will begin enrolling patients immediately. How closely are you watching some of this?
I'll have Regeneron on this evening. I spoke with him this weekend. I have to tell you that of the companies that are ahead, I think Regeneron's well ahead. But that's also because, remember, they had the first one for Ebola. And they have a very seasoned team. By no means at all is Len Schleifer trying to reassure me. He's just saying, listen, we're just constantly working on this, and it's our bailiwick. This is a company that works on these, so I think that that's very early that they're doing it. I mean, that's really ahead of the game. I can't wait to speak to them tonight. The biggest problem, obviously, is when you do a vaccine, is you have to titrate. You can't just suddenly do a vaccine and then load people up with something that kills them. So even if they're doing that, that's your time. But we have to always be sensitive to the idea that in our country, we do not put something that can kill you in your body until we're pretty sure that they're not doing it themselves. They're not killing you unnecessarily.
No, I don't mean to harbor any illusions about the speed of this, but you do want to look for signposts of progress on social distancing, these new CDC guidelines of no gatherings of 50 plus, the trials on the vaccines we're going to eventually need, right?
Yeah, look, I think that when I listen to a lot of the coverage, I really come back to the one thing that's been missing, which is the notion that we are going to solve this ahead of the weather, ahead of what they did in 2018 when it just the thing went away. We have really, really good people who are ahead of the game. Len Schleifer's Regeneron again, which will be on tonight. I'm confident they actually will have something. When people say, you know what, when Dr. Fauci says, and by that point X we'll have a vaccine, what he's talking about are things like what Regeneron's doing, which is to say, okay, every second they're working on a vaccine. I know when I speak to the Moderna people, they're quite confident they have something. I do have a little more faith in Regeneron just because they were well ahead in Ebola, and that they wanted to come on tonight shows me that they're not screwing around. They've got something. So I think you're right. I mean, social distancing, yes, you don't see anyone near me, and I'm as concerned. Did I wear, right, or you? I mean, did I wear the gloves? I mean, do all the things that you're supposed to do. Is it nauseating to do it? You just have to do it. The life has changed. But yeah, I mean, we want to stay healthy, but then we also have to count on our institutions, like places like Regeneron, to be working on things, and that's what they're doing. So I wish that people would not think, you know what, we just have to wait for Mother Nature to run their... Mother Nature, wow, thanks. To run... Mother Nature on the wrong side of the equation right now. We just have to wait it out. I think that what we can do as a network is focus on companies that are so in sync with what we need. Dr. Fauci's not going to come out and say, don't worry about it. And Mayor de Blasio, man, I have to close my restaurants tonight. Well, big deal for me. But, you know, that's a lot of money for small people.
I was thinking about you.
Yeah, I mean,
this weekend,
I try to think, how long can we keep people? We'll keep people on for as long as we can. I would like to, when I speak to the Treasury Secretary, they're talking about target stimulus for just the kind of outfits, not for me, but for kind of outfits that we're talking about to keep people on the payroll. But I really think, Carl, that when we hear that it's just going, we have to let it run its course, that denigrates some people who are so good and are working so hard, and I think come up with something. And I have tremendous respect for them.
It's interesting you said that, because the rally on Friday coincided with the appearance of Macmillan of Walmart in the Rose Garden and Cornell from Target.
Right.
Talk of Google, at least, although the messaging on that was arguably poor. Navarro today talking about FedEx's Fred Smith helping him get some materials back to this country. LVMH making hand sanitizer for the French. How much is the market looking to corporate America for response?
A great deal, I guess, in that sense. And I just want to correct, with Regeneron moving to tomorrow, we have CVS, because CVS was in the White House garden. We want to find out what CVS is doing. We have Thermo Fisher, which is also involved with us.
So also good.
Yeah, they're also involved. I'm looking to Thermo. I'm looking to CVS and seeing what they're capable to do because they were one of the companies that were in the Rose Garden. I'm looking to Dow Chemical, just because I think that uniquely we're looking at high yielders, trying to figure if they can make the money. And then Regeneron tomorrow, we'll be able to say, okay, how far along are you actually? Those of us who actually run tests, I have run tests. Regeneron tomorrow, yes. I have run some tests and done some work in the medical community. I can't believe the speed they're going. I mean, I just to work on a drug that I've got, which I think doesn't hurt, took 7 months just to get to the point where we can even think of enrolling people. This is so rapid, I can't believe it.
Yeah, it's incredible. All of us are learning a lot about biotech in ways we never expected.
Yeah, Carl,
Jim,
you have to understand, these companies, they weren't set up for this. I mean, they're set up to be able to take a long route, the long route. You're not allowed to front run things. You're not. The FDA usually just makes it say, listen, when you get this in the review board and when they sit down and they do the 40 questions, you'll come back to us in 7 months and then we'll run a trial. And 2 years later, we might find the results. And I hope you're ready to spend $500 million. Boy, we're not getting that at all, Carl. Not at all.
No. I mean, emergency authorizations are now the norm out of the FDA in the past week, which has been amazing to watch. We're going to watch circuit breakers at the Open, and for that, we'll turn to Bob Pisani this morning. Hey, Bob.
Hey, guys, and everyone here at the NYSE is at work. You see the people behind me. Obviously, we had some temperature checks. I'll show you some B-roll in a moment here, but let's review the circuit breakers. We've done this several times in the last week or so. There's 3 levels, 7, 13, and 20. Level 1, 2, and 3. Level 1 or 2 circuit breakers before 3:25 p.m. will halt trading for 15 minutes. After 3:25, there is no market halt unless you drop 20%, and that would halt for the rest of the day. A little convoluted, I know, but these were the circuit breakers, and they were instituted. These changes were instituted back in 2013. A lot of concerns, of course, that we are limit down. We've been limit down to the futures several days last week. But remember, the ETFs continue to trade, and they have been very good at sussing out roughly where the market's going to be. We saw this on China. They were closed for a week or more, and we saw the Chinese ETFs here trade with remarkable accuracy. Right now, the S&P 500 SPY, SPY, that's the biggest ETF, closed at 269 on Friday. You see it at 240 right now. That would imply a decline of somewhere at 10.5% to 11%. It's been bouncing around a little bit. Triple Qs, also another ETF, Diamonds, DIA. Similar declines that we've seen. A lot of people trying to figure out bottoms over the weekend. We know for sure this is not working right now. You see all of this up and down here. Down big Monday, up on Tuesday, down on Wednesday, down on Thursday, up on Friday. Stock pickers pride themselves on pattern recognition. A large part of technical trading is based on this, but obviously that's not going to be working, and we need to figure out some sense of when infections might begin dropping. Obviously, that's got to be at least several weeks away. You heard from Wilf talking about the banks. Most of the banks set to drop in the mid 15s, let's call it 15, 18%. Citigroup, Bank of America, Morgan Stanley, JP Morgan, all suspending buybacks. Finally, we were all greeted with a rather remarkable sight this morning coming to work at the New York Stock Exchange. All of us were required to take temperature checks. So these were checks through the forehead. They're remarkable just watching them do this. But we all had to fill out a form asking us if we were working on the floor. If we were, the form asked us whether we had a temperature, whether we were ill, whether we had been outside the country. This is what the modern world looks like right now, but the New York Stock Exchange is going to open. Trading will open. There will perhaps be a trading halt at the open, but nonetheless, throughout the day, the markets will be trading. It's the new normal, but again, as far as I can see, this is a pretty full contingent of people here on the floor. Carl, back to you.
Our Eunice Yoon working on another piece about this chapter that she's already been through, Bob, and says it gets better. So we're waiting for her to finish her piece and get that up on .com. Let's get to Cramer's Mad Dash and get before the market opens. Jim, what are you watching?
Yeah, again, I think that the pressure point is no longer in the the Treasury market, which we can focus on, but I think that Jay Powell took that off the table. The pressure point, I think, is oil. And there's a note by RBC Capital today. I never see this, which is taking ExxonMobil from hold to sell, really saying that this is a company that is not set up for the lower oil prices. I think those of us who know Exxon from the days of Rex Tillerson would find this an unbelievable thing that we actually have to focus on Exxon as a company that we need to worry about. I think that they need oil higher than 30. They don't have it. I think that oil could go to 20. So I'm saying that when you see a company as fine as Exxon being downgraded to sell, you got to be very careful with that group, because a lot of that group has very high yields, and I think a lot of people are looking for yield, and I'm urging you to look for yield away from oil. Do not trust the oils.
Interesting.
Don't buy them.
I wanted to ask you, Jim, about the Saudis today. Aramco CEO assessing, as we know by now, their ability to raise capacity to 13 million barrels a day. We can sustain low prices for a long time, they argue. I mean, what? Do they sense vulnerability?
Yes, they really do. I mean, look, they're not our friends. The Russians are not our friends. It's every person for itself in the oil business. And I'm looking at these and I'm thinking these are very, very fine companies. There are a lot of people trying to figure out the real break-even points. There are people who are triaging certain stocks, Occidental's being triaged. People just realize that they borrowed too much money and they don't have it. So let's stay away from those. Don't reach for yield. Some other things I went over with the Treasury Secretary. Oh, yes. Yeah, look, he's very grateful for Jay Powell. A lot of people feel like, where's Jay Powell versus where the president is? And I know the president, at least through Secretary Mnuchin, has finally recognized that Mr. Powell has gotten ahead of things, and that's very important. I do think that, again, the stimulus is going to be focused on small businesses and keeping the working people in jobs. Liquidity for small businesses is a chief priority. The chief priority is about putting food on the table for individuals. I think that a lot of people who watch the stocks would say, well, what is the impact of that on stocks? And I would say, nothing. They're not trying to save anybody. They're just trying to make sure that the employees get paid. It's an attitude I think that both Republicans and Democrats are probably going to agree to. And I think that Secretary Mnuchin is, because he was a trader, because he understands the markets, and he also has a touch to recognize what Speaker Pelosi likes. It makes it so that there's a lot more unity down there than it may seem.
Interesting. The bank suspension of buybacks, Jim, is that mostly about optics and not about balance sheets?
Yeah, I mean, look, it's very hard to go borrow. You'll have to borrow at the discount window to go buy stock. The banks are going to have big yields. The banks, I think, are a better place to go than the oils. But I don't know at what level they're intriguing. I mean, you get a Wells Fargo run by Charlie Scharf, and you say that yield is probably good because the dividend has actually been the same the whole time. Obviously, the stock has fallen a lot. Do I want to bank with Charlie Scharf? Well, if I had to bank with someone, I would. But I recognize that anytime you said anything good about a financial institution in 2007, you ended up looking a little bit like ill-advised. Ill-advised.
Yes. There is the opening bell and the S&P 500 at the CNBC Real-Time Exchange. On the big board, it is Chris Taylor, Vice President of NYSE Listings at the NASDAQ Foster Pride, helping children and teens in New York City foster care. So we're going to watch for 25.21. That's your first circuit breaker. And at 24.90, Jim, it'll be halted at the open.
Yeah, I mean, look, we're looking at that weird short squeeze in the last hour, Carl, and you knew that had to be wiped out. Right when people were able to get there for those prices, I would be in no hurry, but one of the things I tweeted this morning was like, if it goes down the limit every single day, well, by Friday, we don't have to worry about much. And I'm being a little facetious, but let's take into account that there are people who need the money, and they need their money, and they're not needing their money and saying, you know what, I think that this is the level where I want to take a big swing at General Mills, which reports this week. I think what they're saying is, I need my money, I don't care. They're usually using S&P. And because it's S&P, they're going to create values, because not all stocks are created equal. We got 60% of the money is obviously an index. And so when you blow out index, you're blowing out some companies that shouldn't be sold.
No, it's a dynamic we have talked about for years, wondering when that reckoning would come. Obviously, we're in the thick of it now.
Right. I mean, look, let's say Verizon we're looking at Verizon at 50. Let's say it goes to 45. Do I want a 5% yield that's backed up by the full faith and credit of every single customer in Verizon? Yes, I do. I mean, I like that. And why is it going down? Because it's in the index. It's not going down because anything's wrong with it. It's going down because we became an index nation, because the industry convinced us that we don't know anything about individual stocks. I have always felt and dedicated my money to the idea that you should have indices, but you should own some. But because of the craziness and lunacy that we see where all stocks go down equally, some stocks should Verizon trade like Southwest Air? And I like Gary Kelly so much, but the answer is not all stocks are created equal. And those who think they are created equal are doomed to be able to not be able to profit when this thing's over. By the way, notice I said when and not if. I mean, I don't think we're in a permanent state of end of days. I just don't think that. I'm sure even in 2018, in the month of October, where people were, where there were carts to carry people away, we're just not there. We're just not there.
Yeah. Your point's a good one, though, about the swings. Peter Schacknow is a great statistician of ours and says during the financial crisis, from Lehman to the Haynes bottom, so September 08 to March 09, one day where it fell more than 9%, and that was in October, and that was only 8.9%.
Wow.
The average daily move of the S&P was 2.5. So now we got these 7% moves at the open, you know, a couple times a week. That's why this feels more extreme.
Exactly. Well, we all love Peter, and I would say that a lot of what you're seeing is dislocation. Remember, there are a lot of firms that are always on the wrong side of the trade, and they create opportunities because it's the hedge funds going wild. They don't know what to do. And I would urge people at home to say, you know what? These are companies. I mean, am I saying things like Warren Buffett? Well, Warren Buffett would say you got to do indices, and I really appreciate that. But the indices are not reflecting the real values. Believe me, I think that there are some very common sense companies. Now, 2 years ago, April, you had Amazon go to 1,300 because the president decided he didn't like Amazon. Amazon is the way that we're getting our, in just a 2-year period, Amazon's where we're getting our goods. Do I think Amazon's a buy at 1,600? I know Amazon's got, believe it or not, actually a great balance sheet now. And I think that there's a level where I want to own Amazon. I don't think it's here yet because I know it traded at 1,300 in April of 2018. So why can't it go there again? I'm trying to figure out what stocks went to prices that I actually remember. And if I remember, it's probably too early to buy them.
Yep. It's funny, Jim, you know, I don't want to, we can save politics for another day, but I wonder, given the antagonizing back and forth between Amazon and Navarro, Amazon and the president, is that an inhibitor for Amazon to use their supply chain expertise to our national advantage?
Well, that's a great question. I mean, I think it would be, there is obviously political risk to Amazon. But if you felt that they didn't know what they were doing, there's another company that doesn't have political risk, which is Walmart, that has a very, very good, really terrific business and is for online. They're great online and offline, and obviously they're committed to helping the president. Witness Doug McMillan's comments. I think that it's very interesting what happened at that press conference. I know that Google was caught a little blindsided. I think that the executives didn't go into that meeting expecting that the parking lots were going to be the place that people are going to get tested. They sure didn't leave thinking that, and they made a commitment. So I think that'll happen. I do think that people who think that if you go to Walmart on Route 22, which is a very nice Walmart, by the way, I don't think that you're gonna. That's the day. I mean, today's
no. I think people understand. Like, this Google website is apparently, according to reports today, getting off the ground in Northern California. The messaging is hard, Jim. I mean, even Lagarde had to backtrack her notion of, no, we're not here to narrow spreads, and she later essentially apologized for that.
Well, look, I think there are a lot of things on the fly. One of the things you said, we don't want to do politics. There are many people who are very critical of everything. And I would point out that if you just step away from it, I watched the beginning of the debate last night. And, you know, I'm not talking about the president. I'm talking about the people who put things in place. Like when you listen to Fauci, you listen to the healthcare people. I mean, these people are pretty serious. And what they're obviously focused on is flattening the curve, making sure that we don't all get sick at once, or hopefully not get sick. But that everything's being done on the fly. And why anyone would think that Jay Powell is now done? I mean, they're trying to anticipate everything that could go wrong. I think the thing they anticipated, and I'm so glad they did, was that last time around, people pulled a huge amount of money out of their banks. And that made the banking system really unstable. And they just didn't want that.
Al Arian's point this morning was about sequencing, and as we're talking, Jim, FDIC and the OCC are joining the Fed and urging banks to borrow account window. Our Steve Leisman says it's an incremental move, but definitely worth a mention.
Look, I just think that everybody is focused on making it so that the banks function and the treasury market functions. And then when they're done with that, they're going to look at other things. You know, they only have so much thought power. There are hedge funds out there who think they know everything. I'm sick of them, frankly, because they always seem to know more than we do, and then they turn out to not to. When you're a billionaire, by the way, you don't really have to focus on the things that the people who have $400 in the bank account do. These people have long since forgotten what it's like to have $400 in their bank. I think Jim, that's what they're worried about.
No, we've Last few years, I mean, a well-known statistic has been the percentage of households that don't have 400 in emergency savings, and that's where the helicopter money is going to have to go.
Exactly. I mean, that's what, I mean, I would love to hear from Speaker Pelosi. Try to get her on Friday, because you try to figure out where the common ground is. We know that Treasury Secretary Mnuchin was actually joking about how many times he spoke with her, but the Treasury Secretary doesn't want to get ahead of Congress. And Congress, from what I can tell, is trying to help the working person, too. There are many people who are actually quite surprised that there could be such a convivial attitude between the two. But Secretary Mnuchin is not an ideologue, and Speaker Pelosi wants to be sure that the money gets in the hands of the people. So really, when I speak to both of them, that's where I keep going. Even, look, I got to tell you, I had former presidential candidate Warren on. There's not that much distance between any of these people, because they all worry that the working person, the $400 in the bank person, is going to get hurt. No one is trying to figure out how to save Burger King.
We're going to talk about restaurants in a little bit. Upgrade of Domino's today. You can sort of understand why.
Domino's has a very good system, and I think that that's predicated upon the idea that there won't be enough money for the companies that are private. There's not enough money for Postmates. I don't know. I mean, I think Postmates has got a decent situation. We know we met the DoorDash people. DoorDash has the backing of some very big firms. But if you felt that Domino's has long since felt that those guys are the bane of their existence. If those guys run out of money, then Domino's is terrific.
I agree. And we saw over the weekend, if you noticed, Jim, they sent out an email offering contactless delivery, where you don't have to actually really see or touch your delivery person. That's just a sign of where we are.
Well, that's the Chinese did that. I mean, at least enough putting their thermometer on their head. I mean,
exactly,
like my wife is doing.
Let's get to Bob Pisani and see where we are in the circuit breakers. Bob?
And I had a thermometer on my head this morning. It was an odd experience, but it was effective. I got in, and it's a necessary step. Again, we want to review. I know we're all become scholars of circuit breakers in the last week or so. Level 1, which is where we are right now. We opened down about 8% on the S&P. We'll reopen 9:46 or so Eastern time here. That will halt trading for 15 minutes. Level 1 and level 2 will kick in at any point up until 3:25 p.m. Eastern time. After that, there is no trading halt unless you drop 20%. Then you halt trading for the rest of the day. I know it's a little convoluted, but all of us gotten used to the business about this. We don't know where the market will open here. Obviously, we're down about 8% on the S&P, but the banks were weak this morning. They announced they're going to suspend. Most of the major banks are suspending their buybacks. The theory here that they're going to divert the money into loans. Let's hope that is indeed the case. But you see, these are pre-opens on the banks here. Rather severe drops overall. Where's the support levels? Not necessarily mean a lot. I think the one thing here is 2,500. That was roughly the lows that we saw last week. Here's a 2-week chart of the S&P, but 2,500 would be an important support level. But there you see we're breaking that here. After that, you're looking back here at December 24th, 19. That was 25.31 there. That was the close there, 25.31 on December 24th. And that was the important level here. We'll see if that kind of number is 23.51. I beg your pardon, 23.51. Let's see if that holds. 23.51. Let's see if that holds. Obviously here we're just a little bit below that, above that right now. Let's take a look at what the debate is. The parameters of the debate. Is it U or L shape? That's been the debate all throughout the week and the weekend. The U-shaped people argue that the service economy will bounce back in a few months. The L-shaped crowd, which obviously has the ascendancy right now, is arguing the bounce is going to take longer than small will be affected for much longer than just a couple of months. And as you can see, the market is acting like the L-shape may be more likely than the U-shape. We'll see if that changes around. By the way, the V-shape is gone. You notice nobody's arguing about a V-shape. It's interesting that we're having buy recommendations today on a number of stocks. Caterpillar, for example, upgraded to buy from hold over at Stifel. There are people who are trying to call bottoms at this point. I think it's a pretty bold move, but you can see it's not really working. That stock's still down. We're waiting for that to reopen. Clorox, maybe more understandably, was upgraded to an overweight at J.P. Morgan. We're going to reopen in about 4 minutes. I'll be back on the floor. Some of the stocks may take a little longer because there's going to be some manual opens on some of the bigger names that are out there. So I'll be walking around on the floor checking on the open. Guys, back to you.
Yep. enough to know the floor is well populated and monitored temperature-wise coming in, as we said earlier. Jim, you were mentioning liquidations earlier. I mean, gold's off $62. Is that a part of that story?
Yeah, I mean, deflation. Once again, I just feel like that when we speak to Secretary Mnuchin, I want to just understand that they're looking at things that people say, why didn't they look at? Looking at commercial paper, they're looking at liquidity, and I just think that anyone who's selling stocks on the basis that they don't know what they're doing is really missing the point. I mean, even to the point where they're just in touch with us constantly, and they're in touch with us because they're very much aware that what they can't solve, they're going to go to Congress today on because they want the authority. Obviously, there's some authority issues. But it's very much of a deflationary situation, Carl. And I mean, look, if I had to advise people about what to do at the very moment, I mean, gold is under a lot of attack. If you really believe that where we are is at a moment that is apocalyptic, well, obviously buy gold. I just don't share that. I mean,
nobody wants to go there, Jim.
No, I mean, look, I mean, it is difficult when you're trying to figure out whether to have a studio at your home and say, well, geez, I got to get that cleaned up and maybe take that poster down. But I do want to point out again that other than Italy, and Italy is a great quandary to me because I've used their healthcare system in several instances, and wow, it's a good one. So I think that's, other than the fact of a lot of people being old and they have a lot of people smoke, I keep trying to figure out when will Dr. Fauci tell us why we're not Italy. That would be terrific, but he's not going to do that because he doesn't want to reassure us.
People point to smoking, pollution, the degree to which the elderly live with family members, Jim, in ways they don't necessarily in this country.
Yeah, Dr. Fauci, I mean, a lot of the people in health know that the major reasons why people got sick in China in such clusters is because one person gave it to the rest of the family. And I'm sure that's the case in our situation, too. That's going to happen. But I look at what I'm still not seeing opportunity yet, is what I'm saying. There will be, but I've got to tell you, Carl, if we're going to take out all these different circuit breakers and then take them out, let's see. There is a day called tomorrow. And you're going to come in and you're going to say, well, wait a second. The calmer heads have said that a lot of the hedge funds that got blown out between 12 and 2, which is when they'll have to do meet the margin call, they did their second level of selling. And now I'm going to pick and choose. It's just that we're so index-oriented, Carl. It's so difficult.
I know. Not just that, though, Jim. A White House briefing has now been moved to 3:30. And the fact that it will happen during market hours, it's up to you to interpret.
Well, let's just say that if it's Secretary Mnuchin, I feel that he's very much aware of exactly what we're saying and where the markets are. They do need to have something with Congress today. We need to be able to say that there's no spitballing, that what they've done is try to figure out what was over, with Dodd-Frank, what has made it so that they're clearly limited, and they're trying to get that taken back very quickly.
All right, so there's the bell. Trading resumes. S&P down 253. We're going to watch this all very closely, Jim. Bob was looking at that. And we did talk last week about December 18 levels as a marker. How relevant is that in your mind this morning? Jim?
Oh, I'm sorry. I was just trying to get the sense of what's going on there in Washington.
Oh, yeah,
Yeah, I'm doing my best here. Highly unusual. I just think that these levels they're just things that I do want to buy today, but they're just not down enough. Let me give you a classic example. Let's say J&J. I mean, why I'd pick up J&J? AAA balance sheet. Okay, best balance sheet in the world. Okay, in the world. Better than Warren Buffett. And I look at it, and it only yields 3%. And I say to myself, as much as I like Alex Gorski, as much as I like so much about what they're doing, that is still not at the level, down 14% for the year, where I feel it's a layup. I want 4% yield. I want 4% yield. And if I stick to my guns, I'm going to get it, Carl.
You may get it, Jim. You might. We're going to watch that one. While we have time, and as the S&P's down 277, let's check in with Rick Santelli. As you know, the CME has closed the trading floor until further notice as a precaution to reduce large gatherings in the wake of the virus. Rick, we did get Empire, and we might as well get used to numbers like that.
Yeah, can you do that?
Absolutely.
What's the number?
We should get used to these numbers. They're going to be like this, and they're going to get worse, actually. But remember, first of all, it is really weird, people, to be talking without all the background traders and the noise in the background. Thanks to the CME and our wonderful CNBC crew, here we are bringing you all the important market information. But in the end, exactly how things are going to turn out, I can tell you this. When we start getting the data that really quantifies what we saw in today's empire, then all of a sudden, we're going to be looking forward to the comps as things improve. They say there's no V-bottom. There will be the right side of the V-bottom whenever the coronavirus, of course, starts to retreat. And it's going to happen at some point. Look at these one-week charts and realize that all the extremes, especially in the fixed income space, were established on Monday, March 9th. So, two-year note yields, here we sit. Right now, they're at 35 basis points, so they're down, what, about 13? But you can see the low today, intraday was 26. Last Monday, it was 24, and that is a very significant bottom. 1 week of 10s, it was 31 last week. It was 62 today. 2s to 10s were approaching the high 40s, but today is a major flattener. What, 38 now, 10s minus 2s? And if you look at 30-year bonds, this is the most important maturity, in my opinion, to pay attention to. 1 week ago, their intraday low was 69. Now it's 125 was the low, and it's moving higher. It's all the way back up to 136. Finally, let's look at Boone's overseas. They've had 4 higher yield closes in a row. Today may be the 5th. And the dollar index has had 4 higher closes in a row, but it doesn't look like today's going to be the 5th. Remember, in my opinion, the Fed could do all they want. The key issue for global markets is to satisfy dollar demand. And I think many of the programs initiated by the Fed, especially swap lines, these are going to be ultra important in the grand scheme of things. Carl, Jim, back to you.
That's a great springboard, Rick. Thank you, Rick Santelli, in his new environment. Jim, let's talk about that dollar swap because we didn't really get to that on Powell's presser.
Yeah, look, I understand exactly where I think I understand exactly where Mr. Santelli's coming from. I mean, and he wants to make sure that that's the issue is the dollar. Some people want to make sure that the issue is the buck at the mutual fund. Some people want to make sure it's commercial paper. I would just say that all of these issues are not, let's say, they're on the table, and the Treasury's not obtuse. And so you don't want a Dutch boy situation. You don't want Secretary Mnuchin and his team say, all right, I got to put my finger in this one. I got to put my finger in this one. What I'm saying is that they see what we see. And that it's about attitude, Carl. The attitude in 2007, 2008 was, you know what? It serves you right. That was Treasury, and the Fed was, we're good, what's the issue? This is not the case. We've got a Federal Reserve that clearly understands what went wrong in 2009. We have a trader who is the Treasury Secretary who is saying, yeah, absolutely, we're going to be able to deal with these things. And yes, the one thing that they're not talking about is what is the ratio of people who get sick versus people who spread it. I mean, they're all trying to say, look, we're going to handle the financial side. We can't handle the virus side. That's other people. And while Rick says that it's the dollar and other people saying it's commercial paper, what they're saying is we're going to hold it together financially, but you got to hope that we hold it together biologically. What I think that when we get in the weeds is we worry about individual programs because this is not like 2007. They are listening. They are hearing what Rick is saying. They're saying, you know what, we're interested in that. Do I even ask them about hospital beds? Okay?
All right, so
I asked about hospital beds.
To follow through on that line of thinking, Jim, if we go with Gottlieb's, it sounds like his base case, which is a peak in late April or early May, people or investors, markets are going to need to have stamina for a matter of weeks, right?
Absolutely. So what you're looking for, I would say, are companies that are selling through cash or companies that have the ability to survive no matter what because there's demand for their products. And I think that that's the way you want to analyze a stock. You want to say essential, non-essential. Essential, non-essential. And we know a lot of companies are non-essential. Is the third-tier oil company that we all knew as being, say, a $40 stock, is it essential now at $2? No. We're going to speak to Phil LeBeau. The question is, we need an airline system. Nobody's denying that. But do we need an airline system where the companies make a lot of money? Well, that's not what the president's thinking about. And I think we have to think, all right, what company without help from the government will get through to the other side? And that is probably going to be a buy.
I feel like Annie Hall here because I happen to have Phil LeBeau right here. Phil, what do you think?
Jim brings up a good point. I do know this. Strictly when you look at the cash situation for the airlines, they are in dire situations right now. Doesn't matter which one you're talking about. You talk with the executives, the tenor has gone from, well, this is going to be a rough patch to, whoa, this is really bad. How bad? Look at the capacity cuts. You've got American cutting 75% of its international flights. United announcing last night 50% of its system is going to be brought down. Delta bringing down 40% of its system. And listen to the commentary from the CEOs. Let's start first off with United. Last night, CEO Oscar Munoz sending out a note. He says it is getting worse. That's what he's talking about when he says the situation with demand. Delta CEO last week says negative net bookings for the next 4 weeks. And then you have American. It's grounding 90% of its long-haul planes, sitting them down completely. They're not going to be flying anytime soon. Finally, Southwest, it has not yet cut its summer schedule. That's the one we're going to be looking at today, seeing what happens. And of course, Jim, we're also watching to see if the White House says anything about further travel restrictions. I kid you not, Jim, I have not heard this type of tone from executives in the in the airline industry since shortly after 2001 and 9/11. That's the last time I heard them with this level of concern in their voices.
Yeah, that's absolutely right. What really concerns me, Phil, is that they don't have any control of their situation. Their destiny is sealed by others. And Phil, when I listen to you, what I say to myself is, wow, which one of these is not thinking about the loss they're going to take this quarter, but is thinking about, okay, how do we come out on this the other side, even if it means that the shareholders are not rewarded.
Right, and think about these airlines, fixed costs, Jim. They've got equipment trusts. You know, they've mortgaged some of their aircraft. Well, how are they going to be making those payments? Now, look, they're fine for the next month or two, but increasingly, they need the revenue. United Airlines, $1.5 billion less in revenue this March compared to the March of last year. I mean, that is ridiculous. They are hemorrhaging cash. That's why when you listen to these CEOs and when you hear what's coming out of the White House, there's a bit of a disconnect there. Yeah, the White House says we're going to stand up for the industries like the airlines. Well, the airlines are saying, this is not enough to say you're going to stand up for us. It needs to be done quickly, real quickly, as in soon, like this week. So I'll be curious to see what happens.
Maybe the White House will have something to say about that at 3:30. Jim, Fitch did take Boeing to negative credit watch on Friday, I believe. I mean, there are going to be implications for long-term orders as well, right? Especially given what we've already been through on the MAX.
Yeah, I'm in touch with Boeing, and I know that they're a pressure point in the system. I know that the Treasury Secretary and the President are focused on Boeing in a positive way, obviously. I know that the CFO is very, very savvy. They took down the revolver. You do have to worry with Boeing. They have manufacturing suppliers all over the globe. So they have factories, 2 factories in Italy. So what happens if the 2 factories in Italy close? Well, that means that they could have trouble making the Dreamliner. And the Dreamliners is what providing the cash. So are they on the red-hot griddle? Absolutely. I don't know how to take them off it. I would not recommend the stock here. I think that would be ill-advised of me to do so.
Right. Meanwhile, is Phil still with us? Oh, he did. Okay, he stepped away. Yeah, I see Virgin Atlantic is asking staff to take 8 weeks of unpaid leave. That's where, obviously, policy response is going to be key. Jim, I mean, I know it's early, but 2,400 did hold.
You know, look, you have to just pick, you have to look at the components. And there are things that I think, again, that I do want to buy. I mean, I think that Verizon is cheap. I think that I'm trying to figure out whether Verizon is 50. It's okay. It's not bad. Let's take a look at Procter. If you buy Procter here, you're getting 2.74. That's not enough. I'm doing yield analysis. I'm looking for stocks that have an accidentally high yield because their have fallen, and I'm looking for stocks that are not appreciably that far from their lows within the last 2 years. And I think that's a good
have
thing.
a reason for being in this new world order.
Yeah, and then when the smoke clears, or when the illness goes away, they're necessary. Garden reports this week. I mean, that's a tougher one. I mean, do we need olive farmers? I think we need those people to have jobs who work there. I think that it's a secondary. Your first check down, if this is going to be football, your first check down is to look for companies that have a lot of cash that are going to be needed after the illness is conquered. Your second one is to say, all right, what companies have good dividends that have decent cash flow that I think can get through this? And then your third one is to say, I don't want any of these companies because they could be cash strapped. And there you're thinking about some retailers, restaurants, airline, travel, leisure, hotel. Those are very hard to reconcile.
Yeah, I'm looking at point contributors, or in this case, detractors, Jim. UNH is actually the biggest, 209 Dow points. Boeing follows with almost 200, and Apple's third. Dow's got some quirks we all know regarding price activity, price weight, but that's sort of where the laggards are hurting us the most.
Right. I mean, Apple's problem, it was at 170 back in June of 2019. So it's kind of like there's another one where I said, well, I remember when that stock used to be much lower. UNH was lower during the period when Elizabeth Warren was attacking them. Morgan Chase obviously is an outlier. That is very, very low, and that might be interesting after in a couple of days. Might want to do that. Boeing's
really?
Problem, yeah. I think.
I mean, all right. Good. I know. I only ask because financials, I think, is the worst performing sector, down 14.
Let's say JP Morgan had this decline every day. Remember, let's say it got back to 54. I mean, that's when Jamie Dimon made his big buy, called the bottom. I think that this time may be similar. I know that's far away from here. Wells is very interesting because, again, it's Charlie Scharf. He's rebuilding the bank, but it's still got its tremendous franchise. But you're right, Carl. I mean, I didn't want to put the banks on with the oils. Because they just trade so awful for so long. But there's a level where they're interesting. They're not going to be as interesting as buying a staple, though, or buying a utility, or buying a drug stock. Many of the drug stocks are very interesting to me.
Real estate, the best performing sector today, which is down only 8%. Jim, so CVS tonight?
Yeah, I've got CVS. I think let's see how they're handling what's going with the president. Thermo Fisher is the company that I think has the tools to be able to win the war, and I think we should be calling it the war. And then Dow Chemical, a lot of people are saying, what do you do with these companies that have big yields, Jim, that look like they can't be sustained? And I know that Jim Fitterling is going to explain to us why that it may be an actual buy. There are other companies, by the way. DocuSign, okay, I really like that. I really like Zoom. Why do I like these? Because, Carl, if I have to work at home, I'm going to need DocuSign. I did a DocuSign deal on Friday. I didn't want to deal with any of these bankers. They're the last people I want to touch. And then, I mean, hey, you can only have so many gloves when you're dealing with bankers. And then I think Zoom is, well, how are we going to communicate? We have to have Zoom. And Zoom is the winner here. When the smoke clears, people are going to forever change the way they do business. Turns out to be pretty good at home.
Jim, stay healthy. We've never been more grateful that you're a germaphobe to begin with.
Well, just saying, Carl, I got the thing. Hey, you know what? You got to go like this. You're supposed to take it to your hairline. Then I'm going here and stuff. But no, I mean, it's right to here. I wish they were a little more sensible about the follically challenge to know how high you got to go.
Yes. We'll see you tonight, if not before. Our Jim Cramer, thank you for your commitment and your energy. Let's get to Bob Pisani on the floor. Hey, Bob.
So we had our initial trading halt. This would have been the third one the last week. We halted at 9:30, 9:31. Between there, limit down at 7%. We reopened at 9:45, 9:46 or so. We hit a low. It was a little 24.09 or so, let's call it. We're off of that low. We're now at 24.47. If you take a look at the sectors, this is one of those I used to call them global takedown days, where essentially most of the market is down 10, 11, 12, 13%. It doesn't matter if you're looking at financials or energy down, real estate's down as well, materials, technology, everything down 10, 12%. The REITs and the utilities and REITs a little bit better, but not much, frankly. Banks we've been talking about all day. Most of the major ones have announced suspensions of their buyback program. They are saying they're going to use the money instead to give out additional loans. We'll keep an eye on that, of course. Let's just review the circuit breakers again. As you all learned last week, you drop 7% once, you halt. But then if you rally back and then you're down 7% again, there is no second halt at 7%. At that point, you go to down 13%. All of this applies until 3:25 p.m. Eastern Time. After that, there is no trading unless you drop 20%, in which event you would halt for the rest of the day. I do want to point out that big effort here to get all of these stocks open. And remember, here at the New York Stock Exchange, it's not an all-automatic open. It's not an all-electronic open. There's an attempt to do price improvement by the market makers. So sometimes, and in many cases this morning, they're doing manual openings, and that makes the opening come back a little bit slower. Again, the theory here is getting the price right is better than opening it as soon as you can right at the open electronically. We'll keep an eye on that. I'll be walking around the floor. I'll give you an update in just a few minutes. Guys, back to you.
Bob, thank you. Good Monday morning, everyone. I'm Carl Quintanilla, live at Post 9 of the New York Stock Exchange, along with Mike Santoli. Faber has the morning off. We're going to see Sarah Eisen around the closing bell this afternoon, along with the White House presser at 3:30. It's another tough day for stocks. Circuit breakers did halt trade for 15 minutes at the open. Mike, you had some good perspective on I don't know, are we using the word crash even though it's happened over a series of a couple of weeks?
Yeah, I think it's almost more appropriate to use crash just because of how vertical it's been, almost 30% in 3 weeks. So slow motion crash or really fast plunge into a bear market, however you want to talk about it. I do think that one aspect of a bear market is duration. It's the kind of way that we all kind of reorient ourselves around this. And one of the distinguishing things about the current episode is it came from an all-time high. I mean, even if I keep talking about, you know, October of 2008 and all that stuff. By the time Lehman Brothers failed, the S&P was already down 20% from its high almost a year earlier. So there was a grind to it. This is much more of a sudden stop, just the way the economy has. And it's interesting because the market is always going to try and race to price in its best guess of the future, and often is going to overshoot when it does that. The problem is you're now having a market that's overshooting an intentional overreaction by economic actors, right, and by governments. You're really almost hoping that it looks like an overreaction so that this actually gets under control. So I do think that's one of the things that makes this very difficult to handicap and also compare to prior instances.
Yeah, all right, so given what you just said, what do the levels that held a few moments ago for now tell you?
Well, I think one thing to keep in mind is that crazy last half-hour ramp we had on Friday was almost going to be unwound over the weekend no matter what, in my view, at least tested. And so I do think that right now we're a few percent below where we closed on Thursday, and we're hanging out here for a while. I think our 2018 lows are going to be significant around 2350, though, if in fact this we get another wave of selling here. I think we do want to get out to Steve Leisman with the Fed making that emergency rate cut move yesterday, as well as some other measures. Steve?
Yeah, Mike, thanks very much. So the day after that absolutely historic moves by the Fed, where essentially what they did is they took a bunch of stuff they did during the financial crisis era over a series of weeks and months, did it all really in one night. Maybe more yet to come. People I'm talking to in the markets right now are really waiting and watching for the impact of what they did last night to show up. It certainly hasn't shown up in the stock market. Although one person said to me, can you imagine where the market would be right now if the Fed had not done what it did last night? But they are still waiting for some improvement in some of the spread, some of the relative value of cash to futures market in the Treasury, some of the more esoteric derivative numbers that have blown out. But what they really want is they want the Fed to come into the commercial paper market, and there's a lot of concern about what's happening there and companies' abilities to finance themselves. That's something that they're going to have to do ostensibly with the Treasury. A lot of talk about that. Let me go over quickly what the Fed did in case you're just catching up here. It cut rates to zero, full percentage point cut, $700 billion of asset purchases, and indeed they're waiting for that to happen today. $40 billion will be spread out over the day. We'll have to see as these operations occur if there's any improvement in markets. They slash reserve requirements to zero for thousands of banks, and they ease the terms and the rates at the discount window and on these dollar swap lines. Guys, we were in the field with a survey, a Fed survey, before the Fed took these actions, and I want to show you where they put the recession probability, which is now 67% according to our Fed survey. It's the highest we've ever had in the 10 years we've been doing this, and that's up from 41%. That's the probability of a recession in the next 12 months. Now, let me show you, because we asked for the first time here, the growth trajectory expected by our 40 respondents. And this is very telling because it's very similar to what Fed Chair Jay Powell talked about last night. A modest first quarter growth, an actual decline in growth in the second quarter, about flat next quarter, and then the rebound happens in the fourth quarter. This is 6 months later than anybody was ever talking about. I want to say as recently as 2 weeks ago or a week ago, but now the outlook is for an outright decline in the second quarter. And essentially what Fed Chair Jay Powell said last night is the third quarter is up in the air relative to the spread of the virus and the amount of economic activity that has to be reduced in order to keep it from spreading. Carl?
Steve, I mean, 67%. Do you wonder what the other 33 are thinking?
I think they're thinking we can just barely avoid it. Look, a recession is not really 2 negative quarters of growth. A recession is when the National Bureau of Economic Research meets and determines that you've had a prolonged, protracted, and pervasive decline in economic activity through a whole bunch of different metrics. So it's possible to technically avoid. I've heard analogies this morning, Carl, to the 1980 recession, a short, sharp drop followed by a quick rebound. It was long enough to count as a recession, but it was short, although severe. That's one analogy I read this morning. It's possible that some people think that the combination of Fed policy and fiscal policy can help us avoid an actual recession. But as you see from that graphic, there's a large percentage of people who don't think that's possible at this point.
Steve, one other thing, of course, we all remember from the financial crisis was the Fed and other, parts of the government attempting to stem the spiral and trying to come out with measures, and the market either liking it or not liking it, and they had to go to the next step. This idea that perhaps pretty much everybody expects something with regard to commercial paper backstop to happen. Did that not happen this time because perhaps the Fed didn't feel it was necessary yet, or because it just couldn't be put together in time?
I think it's more the latter. Somebody described it to me, and this is not inside the Fed, but outside the Fed, is probably a bandwidth issue. As you saw, Mike, from the list of things that we put up there, the Federal Reserve did an awful lot last night. This thing with commercial paper, I believe, requires approval of the Treasury. They ought to be getting together and doing this. I've heard people talk about the need for absolutely targeted relief to specific industries. Healthcare and the airline industry are two that were brought up. The Fed can do this, but it needs to do it with Treasury. There have been some changes to the Fed's emergency authority after the Dodd-Frank bill to do that. I've heard talk, or there's one idea that I actually had, which is to eliminate the stress test. I don't think, Mike, at this point we have a problem with bank solvency. And I think that's something we're going to have to watch very carefully. But the banks are said to be well capitalized. I think the Fed is going to have to work to keep it that way.
Steve, thank you. We will talk to you often today. Our Steve Leisman working remotely. We did trigger the first circuit breaker if you're just joining us at 25:21. We won't trigger the second until 23:58. So almost 100 points below levels that we're at right now. We're joined by Wells Fargo Asset Management Senior Economist Mark Vidner this morning on the CNBC Newsline as well. Citi Private Bank Chief Investment Strategist Stephen Whiting. Gentlemen, thank you for your time today. We appreciate it. Well, we know
Good morning.
With everything else going on, it's truly valuable to our viewers. Mark, I want to ask you, as Leisman just said, deep and short. That's the phrase we keep hearing out of Deutsche, Goldman with similar comments. Is that naive?
I don't know that it's naive. We didn't have any obvious imbalances going into this crisis. Housing wasn't overbuilt. Commercial construction wasn't overbuilt. Businesses didn't overinvest in plant and equipment. Household balance sheets were in really good shape. The savings rate was 8%. So the typical cyclical imbalances that lead to a deep and prolonged recession just don't exist. And so I do think that we're probably looking at a pretty sharp contraction in the second quarter. And you really want to look at a range of outcomes, so maybe something like 3 to 5%.
Yep.
And the third quarter, it depends. It depends on how this virus progresses.
That's not the first time. Yeah, I think Goldman's going with the number 5 as well. Stephen, to the degree you can address the next couple of quarters, where are you and what kind of assumptions are you making?
Well, look, flattening the curve to prevent overwhelming our healthcare system means that you deepen the economic impact. And so these are really unprecedented lockdowns of economies. It's happening sort of top down in Europe. It's following a pattern that you saw in China. In some respects, not as severe. In other respects, more severe. And it's happening sort of bottom up right now in the U.S. economy, where anybody responsible for people is making this happen. So it's going to be an incredibly severe drop for travel, hospitality, all of these sorts of things, and discretionary spending. But, just as Mark had said, this is not an economic deterioration. As Steve Leisman said, this is not an undercapitalized banking system, not a financial crisis. So where the third quarter comes out really does depend on the policy response. Can you sort of, build the bridge over this coronavirus depression over a short period of time? And then if you haven't really harmed economic capacity, if you haven't had a chain of defaults from the actors who've been so hurt by this, then you can have a sharp recovery. So it's really critical now to get the fiscal response, now that we've seen monetary policymakers make it even easier to borrow.
Right. That's a very tough balance. Mark, where do you think the market wants to see that second derivative on the health curve? Does that have to be an April story?
It would certainly help if it was an April or early May story. I mean, I think we're hearing 4 to 8 weeks, and the CDC is recommending social distancing for 8 weeks. So I think that certainly somewhere in the ballpark there, we have to see that we've gotten that second derivative and that the number of new cases is growing at a slower rate. I also would like to reiterate, though, on consumer spending, I know it feels like everything is absolutely stopped, but 2/3 of consumer spending is effectively on autopilot. Our biggest point of consumption is housing, which is your consumption of housing or the rent of housing. And then you've got utilities, insurance, and things that cable, which not cable or whatever you're cutting the cable service is.
Sure.
You've got all of those, that type of spending, which is likely to continue. So that's something that's a little bit different in the U.S. Well, it's very different in the U.S. than in China.
Stephen, obviously markets are not really equipped to, in any kind of precise way, try to handicap and discount this type of sudden stop. How, as an investor, should one approach this right now? I mean, normally, I guess long-term investors say, look, I'm in the business perhaps of buying a 25% break or slowly buying a very dramatic decline in equity values that wipe away a couple of years' worth of gains, but we simply don't know what the next step is or how deep this has to get. So what do you think markets are right now pricing in, and how should investors treat them?
Well, it's disorder at the moment, and again, for equity investors, for institutional equity, managers, I think we should look a little bit to credit markets. We should see, obviously, the Fed is trying to address something that's malfunctioning, but you've got to take, that into account. The fact that corporate bonds, even investment-grade bonds outside of the energy area, have seen bids and offers, far apart. This dysfunction, right, which we last saw in the financial crisis, even though our underpinnings are completely different, over the short run, that adds a great deal of volatility and downside risk to equity markets. But certainly, yes, we will overshoot here. And, if this is not going to be something where the economy's capacity to rebound is broken, you'll end up with great returns 12 months out. But I think you've got to be careful about saying, any line in the sand about where exactly, to price an asset when markets are dysfunctional over a short period of time.
Yeah. Mark, as we're talking, Reuters with an Energy Department source, U.S. could start purchasing crude for the SPR in as soon as 2 weeks. Could, within months, purchase 77 million barrels of U.S. produced crude. I don't know how much you can delve into the energy markets, but what kind of contribution could that be?
It certainly helps a little bit. I don't know that that's going to reverse the prices, because really what's happening in all asset markets right now, in commodity markets, is that it's the absence of information that is sending prices lower. And so this helps. And from an individual standpoint, this is great. Normally when the government's adding to the stockpile, they do it at higher prices. So it's nice to see them doing it at rock bottom prices.
Mike?
Steve, anywhere around the world kind of gotten to this point beforehand? Are there any models, at least in terms of how the economic shock might be absorbed, that you have your eye on that perhaps we can anchor to?
Well, I think, we're looking at China. In some respects, again, because of the Lunar New Year migrations, their factory shutdown was unbelievably sharp. It was extremely sharp. But so what we're seeing, again, is a bit of a repeat of the social distancing in China, but in places where we're not used to it. It may be less effective. So we might find, again, larger disruptions in some places in these Western economies, including the United States, and in other areas it's just not going to be quite as severe. But China is making a rebound right now from this. Again, social distancing is becoming less severe. Governments are putting people back to work. We still think that there are negative second-order impacts of the trade shock around the world that will slow down China in the rebound phase, and the possibility of reinfection is there. But at least, again, in many respects, what we are is following, China with a 1-month lag. And, again, in an optimistic scenario, with all of the steps we might take, to protect the affected parties who are going to lose income over this period, it's possible we could follow that. In financial markets, again, in some of the Asian markets have actually outperformed a bit. I think we can tentatively, very, very tentatively, look to that and hope a bit that we could follow that path.
Yeah, I'm actually a little more optimistic than the China case, because I think where we're seeing a comparable shutdown is in the travel and leisure sector, and that will pop back pretty quickly. We're much more service-based and in professional services. I think a lot more of that work will be able to get done remotely, and we won't see as dramatic a pullback in our service sector as we saw in China's manufacturing sector.
That's a good point, Mark. Certainly the ability to work remotely, as we show our viewers every day, is a silver lining. Mark, Steven, stay healthy, guys. Talk to you soon.
Thank you.
Well, as cases of the coronavirus keep growing, one hospital in Chicago is doing its best to screen as many patients as possible. Recently, Rush University Medical Center set up these tents raised over its emergency department's ambulance locations, which creates an area for testing potential COVID-19 patients in isolation from general patients. And joining us on the CNBC Newsline is Dr. Omar Latif. He's CEO and president at Rush University Medical Center. Doctor, thank you very much for calling in this morning. Clearly, you are preparing for a surge in potential new cases, in people getting screened. What are you seeing right now in terms of infection rates and volumes of people getting tested, and what do you anticipate?
Well, thank you for having me. What we're seeing is a lot more action and a lot more concerned patients coming in and presumptive cases being diagnosed every day. We have a doubling in the state of Illinois over the last 2 days. So what we're seeing is a continued increase in the numbers. So we're on the way up of the curve for infected patients.
And these measures that you're taking, I mean, this sort of separate screening area, a lot of what we're hearing about the potential stresses on the healthcare system are being able to test everybody, but then treat those infected. I mean, what does your facility look like in terms of capacity, and what could you take on? Is this going to add to your ability to take on more patients?
Yeah, thank you for bringing that up. So really the three biggest challenges our entire healthcare structure is facing right now is our number of beds, adequate supplies, and exposure to our personnel. So 2 weeks ago, we sat down and said, no one's going to critique us if we're over-prepared and we're in an empty hospital years from now. But if we're not prepared and can't take care of our city and our community, then we've let them down. So what we've done was built out our ambulance space to be a coronavirus triage area. We closed off a third of our ER, which is massive, so 20 dedicated beds that we could flip to 40 for patients to go through a private entrance into one area, and then took an entire area of the hospital using some technology, flipped some switches and changed the air pressure. So what we're trying to do is isolate those beds and those patients from the rest of the hospital by the safest way to increase the number of beds specific for this, to safeguard the supplies in those regions so that we can continue to care for people, and then to minimize exposure so our healthcare workers can work. This was a very aggressive stance to prepare for what may happen, but we're seeing these numbers make it more likely that this will happen. So factually, we flipped our hospital from our daily operations of taking care of everything to preparing for the worst case scenario that we could possibly prepare for, in conjunction with a phenomenal city response and state response in Illinois.
Doctor, when you get on the phone and you are making requests, you're telling people what you need, who are you getting to talk to, and what are you telling them you need?
So one of the advantages of surge moments like this in healthcare that we've experienced over time is the coming together of hospitals that historically compete with one another under the guise and the direction of city leadership and state leadership and even federal leadership. In this case, the Chicago Department of Public Health has international experts in infectious disease with a tremendous amount of experience, and they are crowdsourcing through the mayor's office the leaders of these individual hospitals on a daily call to share information, to share knowledge, and to request resources that we need. So we feel very confident at this point in time that we have a listening ear to people that have the ability to go out and get those resources so that each of our hospitals can work together to provide the care that we need.
It's one of the most encouraging things we've heard all morning. Doctor, on behalf of our viewers, we're grateful for your work. Stay healthy, try to get some rest. Thank you.
Thank you.
Dr. Omar Latif. Retailers across the country announcing closures and shortening their store hours in the hopes of limiting the outbreak. Our Courtney Reagan has the latest from the NASDAQ today. Hey, Court.
Hi, Carl. Good morning. So these lists are going to continue to change because it's really just become a new normal in this country where officials are asking us all to limit our gatherings and encouraging social distancing, imposing curfews. But this is where we are, at least now. Among the retailers that have closed, most of these are at least 2 weeks. Names like Apple, Nike, Under Armour, Lululemon, REI, Columbia, Patagonia, Abercrombie, Aritzia, Levi Strauss, Urban Outfitters. Plus, you've got smaller names closing up their stores like Warby Parker, Everlane, Allbirds, Glossier, and Away. The good news for employees is these companies are planning to pay employees during the time that the stores are closed, and online operations are still up and running for the most part, at least for now. Now, there are other names that are shortening their hours. These are mainly grocery stores, and they're doing so in order to have time to restock and clean the stores. So these names with shorter hours include Walmart and its neighborhood markets, as well as Sam's Clubs, Publix, Stop & Shop, Natural Grocers, Wegmans, Trader Joe's, and some Kroger stores. Then you've got some non-grocers like Gap, Old Navy, Banana Republic. They're also operating under reduced hours. Just yesterday, I saw a sign at least one West Elm that said that it was also doing the same. Williams-Sonoma, though, at least has not yet confirmed wider limited hours, but you may find these at some of the stores that are near to you, and it may be up in some cases to the discretion of the local managers. Now, B. Riley FBR analyst Susan Anderson estimates that annual earnings will fall an average of 18% for the specialty retailers in her coverage as a result of these closures. If they last for about 2 months, if it's longer, it could be worse. 2 weeks, rather. Piper Sandler analyst Aaron Murphy estimates that Nike and Lululemon's annual earnings will fall just 2% and 3% respectively from these closures. But Under Armour's earnings, she says, could take a 16% hit. Now, the big retail lobby groups like the National Retail Federation and Retail Industry Leaders Association are joining together, putting out statements telling consumers, quote, retailers, particularly grocery providers, are working with manufacturers, suppliers, and government agencies to make certain essential products and services remaining readily available to customers. The groups are urging consumers not to hoard, saying, quote, hoarding products only contributes to the fear surrounding the virus, and any hoarder acting with malicious intent to drive up prices on a secondary market should be prosecuted to the fullest extent of the law. Back over to you.
Nobody should do it, Court. We know that, obviously. Really quick, when you're looking at the closures so far, and we're trying to get a sense of which one might say, all right, 2 weeks will be the end of it, we'll reopen in 2 weeks. Are you looking first to Apple or somebody else? And what is this all doing to e-com in general?
So this is a really tricky one about who opens back up first. And truly, I think it's going to have to be a wait and see. I'm just not willing because, frankly, the retailers aren't willing to give us more information about how they're making these choices. So I don't think it's fair to sort of go out on a limb and speculate there. When we're talking about e-commerce, Carl, this is a tricky one because I think there are some names that have a decent e-commerce exposure. So it makes sense that you could see some shifting online, particularly the names that use those stores and e-commerce together. Then there are others where it just doesn't translate as well online. If you're thinking about body lotions or candles, like a Bath and Body Works, that may not see those sales translate online.
Right. That's the question we're not going to know the answer to for a long time. Courtney, thanks. Talk to you in a little while. Courtney Reagan. We're glad to have our next guest join us now. Morningstar's International Stock Fund Manager of the Decade for the 2000-2009 period, David Harrow, is on the CNBC Newsline. He's partner and chief investment officer for international equity at Harris Associates. David, thank you for your time today. We appreciate it.
Yes, happy to be here. Happy to be here.
So, talk to me about how you're viewing the landscape right now.
Well, I mean, clearly we have an example where emotion has kind of surpassed what we'd say is common sense. And what do I mean by this? We have share prices down anywhere from 30 to 50%. And I'm listening to your report just in the prior segment about what earnings are going to be down this year. You know, the earnings are going to be hit this year. Earnings are going to be hit this quarter. But the business value, the long-term intrinsic value of these businesses is not going to be hit anywhere near with the share price movements we have seen, especially in Europe, by the way, where the average industrial or financial is down close to 50%. And let me tell you this, that Europe started the year at a much lower valuation than the U.S. did. So our kind of hunting ground, stocks outside the U.S. in particular, to us, Europe offers value. Now, you have to be careful. You have to make sure you're invested in businesses that have the balance sheet to make it through this short-term period of weakness. And this is exactly what we've been trying to do.
Interesting. Are you saying that Europe is overshot already? And how much is contingent on fiscal response there?
Yeah, and I think this will be a bonus because we get fiscal response. Of course, monetary policy there's always been loose, evidenced by the negative interest rates. They will probably be a bit more aggressive as well, especially from a regulatory perspective. They haven't really given us, there's been little fiscal programs here and there, but I believe there's going to be more fiscal programs, especially to hit particular areas that have been affected by this. But in the meantime, if you look at the share price movement in local currency terms, yes, anywhere from 35 to 50% stocks are down. And so even if you take a half year's earnings away, to us it just at some point represents really good value, or it represents good value today, but at some point people should really be considering want to start increased exposures to these businesses. These businesses, most of these are going to just be just fine in, a year from now, a half year from now, as we get through the healthcare crisis phase of this. You're going to have some very viable companies selling at extremely low prices. And to get quality cheap, this is, you get these shocks. It provides opportunity. But you have to be careful and you have to be selective. And you don't put all your funds to work at once, but you slowly start getting exposure to those quality areas which have been hit hard.
Yeah, David, I was going to get to that idea. Just exactly how urgent would you be in terms of trying to seize on some of these prices? The market can always get further taken by emotion to the downside. And obviously, this has happened over the last few weeks when it seemed like it was kind of that panic moment, and then we've gone lower still. So are you being more careful sort of tactically in terms of getting in, or do you feel as if these prices are not going to last long?
Well, this is one of the things, sadly or happily, I've learned, and I've been doing this since 1986. And you don't rush, but you start to slowly and in a disciplined fashion increase exposure to those high-quality areas that have been hit, because you will be given more opportunities. But you never know when it turns. All it's going to take, imagine a news story when there's now a treatment available, or you heard today that there's a vaccine they started testing, which could even accelerate
accelerate the end of the healthcare scare. You're going to have the healthcare scare, which we're working on now. We're feeling the pain, the closures, all of this. And then we have the economic impact. And the economic impact could be somewhat blunted by government policy. I'm happy to see that governments have been very proactive here. This is another lesson our governments have learned, to be proactive and to, overshoot, if anything, on the cautious side. But, at some point, this will end. This is not a permanent condition, as we know, this virus. And, of course, though it affects different slices of the population worse, for most of the population, it doesn't really have a tragic impact to. So this will be behind us, and this is why, given the share price movement today, I believe it's time to gently and in a disciplined fashion increase your exposure to those areas, those good businesses with strong balance sheets. I mean, take like a BMW, 16, 17 billion of net cash on their balance sheet. These are examples of companies that have been hit from a share price perspective, but have a good business model, a strong balance sheet. Right now, probably trading at under or around 1 times its cash flow.
Although, David, I mean, aren't you minimizing the notion that consumer behavior will be permanently altered even after this is, quote, over? I mean, a BMW, whether it's your capital constraints or just nervousness about the future, you're not saying people are going to rush out and buy a new Beamer, are you?
No, I don't think people are going to rush out and buy a BMW right as soon as this ends. So you might get a little bit of relief spending. People, we're starting to already get, we've all been cooped up and we want to go out and do things. So I think you will see in certain areas of the consumer responses, a relief response that this is all over with. Now, whether they run out and buy a BMW is another question. But on the other hand, BMW, or a company like BMW, has a solid brand. It's been around for a long time. It has a huge pile of net cash on its balance sheet. And it will get through this. And there will be a time when people start buying BMWs. Now, it's probably not going to be right after the health crisis ends, but there will be a time when people can, want to treat themselves and will buy a BMW. And I'm not saying it will happen now right away, but in the meantime, it has the balance sheet and the financial strength to get through this.
David, we thank you. Please call back soon.
Thank you. Okay. Take care.
David Herrera.
Bye. Bye.
Time now for a CNBC News update. Sue Herrera has that back for us at HQ. Hi, Sue.
Indeed, I do. Thank you, Mike. Here's what's happening at this hour, everyone. Spain has overtaken South Korea as the 4th most virus-infected country in the world. Confirmed cases have risen by nearly 1,000 in the past 24 hours to more than 8,700. Public transport in Madrid was virtually empty as people continue to stay home during the country's state of emergency. Germany has partially closed its borders with France, Switzerland, Austria, Luxembourg, and Denmark as it steps up efforts to stem the spread of the coronavirus. Germany's interior minister says people without a valid reason to travel will no longer be allowed to enter or leave that country. And the streets of Paris are very quiet today as bans go into effect, shutting down restaurants, cafes, and non-essential stores. Supermarkets, however, are seeing lines out the door as people rush to stock up. And in Greece, grocery stores have begun limiting the number of customers allowed in their shops as part of sweeping measures aimed at fighting the spread of the coronavirus. Starting Wednesday, Greece will shut all stores except supermarkets, pharmacies, banks, and gas stations, and travelers from abroad will be quarantined for 2 weeks. You are up to date. That's the news update this hour. Carl, I'll send it back downtown to you.
All right. Thank you very much, Sue. About an hour into trading on this eventful Monday morning. You can see where we are. Dow's down 19.20, about 8.25%. S&P down 213, 24.97, which is, Mike Santoli, about 100 S&P handles above the session lows.
It is, yeah. There's been a little bit of affirming, and it's interesting. We've had a couple of these halts in the last couple of weeks, and they seem like afterward there has been a little bit of a calming in the waters. Although I would point out, we just showed the S&P and the Nasdaq down almost exactly the same percentage, and that is indicative of a market, and the Dow is exacerbated by Boeing there, but indicative of a market that is trading as one. It's not really having a lot of differentiation, and a volatility index at 75 basically tells you that. These indexes are just very kind of agitated and trying to find their footing.
What did you make of, people have been talking about the timing of the Powell presser last night, this idea that can't wait till Wednesday, what does that mean? Same with Bank of Japan. Did that sound to you like a negative, a reason to worry, or is it more of an appreciation factor that they acted before Monday morning?
Yeah, I don't know. It's very tough to do the counterfactual. What would we be doing in the markets right now if the Fed had not acted? I do think that we were going to probably be down. There are these ways to get early indications before the futures open up that we were probably going to back off that big Friday rally a little bit anyway. But I do think that the Fed and the markets are both reacting to essentially the same thing on the same schedule. So I don't know if it's that the Fed, had some scary information the market didn't have, but just that things did seem to tighten up and worsen more over the weekend. They wanted to try to get out in front of it, and it only seems to have partially had effect.
Yeah. It's kind of weird having you at a different desk, but
it's going to be something to get used to.
Yeah,
yes.
That's right. Yeah. Meantime, let's watch oil. We're back, almost back to 30 here, within 9 cents, although down more than 50% for the year. Brian Sullivan's with us on the Newsline. We can talk about that, what the Saudis said today, and a lot more. Hey, Sully.
Hey, Carl. Yeah, we got a lot to talk about, don't we?
What's on your mind?
Okay, well, let's see. We're below 30. And remember, a lot of countries are buying up oil right now because they want to fill up their tanks. They view this as, buying on the cheap, oil hoarding, if you will. The question is going to be what happens when those tanks are full, whether that's 2 months or 4 or 6 months out. It's hard to know because inventories by countries are very different. That's what everybody seems to be focused on right now. Also, remember the president saying we're going to fill the strategic petroleum reserve, quote, to the tippy top last week. Well, that's not helping oil because here's why. There's 634 million barrels in these SPRs now, and remember there's 4 of them. Total capacity is about 715 million barrels. It's a fill rate of 4 million. So theoretically, you could fill it up in 20 days. And after that, what happens?
What do you make of Aramco now saying we are assessing, as we heard last week, a capacity up to 13 million barrels a day, and that almost sort of touting the fact that they can survive low prices longer than anybody?
It's a full-on price war, Carl. I mean, there's no other way to say it. Listen, it's a market share battle. And the Saudis are going after the Russians in many interesting ways. For example, reading some stuff from some of these oil research inventory firms, the Saudis are dumping a lot of cargoes in Egypt. What does that mean? Well, what does that means that they're trying to grab customers that had normally been Russian customers. Saudis also making, of course, these deals with China that really sparked the price war about a week ago. So it's not just that they're putting oil on the market, Carl, it's where they're putting it. Egypt, the Urals, some of these markets that Russia had really dominated, the Saudis are basically saying, hey, you know what, why don't you try some Saudi oil? We'll cut the price for you because Saudi's cost per barrel is so much lower than the United States. Of course, you're hitting the supply side, Carl. On the demand side, where are we going to be? If you look at China data as far as vehicle traffic, RBC and others this morning suggest U.S. demand could be down 4 to 5 million barrels a day. We use 20 million barrels a day. Half of that's for transport. And so supply's going up, demand's crashing. It's possible when inventories are filled, you could see high teen oil. I hope not.
Yeah. Hey, Brian, obviously, credit market response is front and center in the market in general, and of course, more so in energy. I know you've been on that. Where are we, do you think, in terms of any kind of reckoning, in terms of North American producers essentially having to fold up, any shoes dropping, dividend cut? I mean, all the stuff that we're expecting to see. Where are we on that curve?
Yeah, we're sort of at the beginning of the curve. And yeah, we've said for years, oil is not an oil story, it's a debt story. And you've got $86 billion in debt next couple of years. The good news, because everybody needs a little good news, right? The good news is that there's very little oil-related debt due this year. It ramps up next year. 2022 is the big year. Now, with all these Fed programs, will there be some relief on the oil debt side? I think there's a lot of questions around these programs. We don't know. But the debt story is a problem. Now, I'm talking to guys and saying, hey, is oil debt falling? And they're like, we don't know because there's no bid. You know, you can't trade oil debt down if there's no buyers. That's the problem. Now you've got all these funky instruments that we've been talking about for a while, all these crazy ETFs and stuff, which are supposed to be liquid, but if the underlying bonds can't trade, I'm not sure how liquid these ETFs are. We're going to the reckoning of all these crazy products. That'll be a longer dated story from when this is over. But yeah, guys, the bonds, the ones that are trading are trading well down. The problem is that there's no trading. There's no liquidity, so we don't really know.
Yeah, obviously an issue for multiple parts of the market. Brian, thanks very much. Talk to you again soon.
Bye-bye.
Meantime, some of the country's biggest banks announcing they are suspending stock buybacks through the second quarter due to the coronavirus outbreak. Wilfred Frost joins us now on the phone with more. Wilf, obviously somewhat understandable given the general cash squeeze going on, but perhaps not too opportune in the timing given the levels of these stock prices.
Absolutely, Mike, and also some questions exactly about how this was announced. By the way, was via the Financial Services Forum. So the eight U.S. globally systemically important banks, J.P. Morgan, Bank of America, Wells Fargo, Citi, Goldman Sachs, Morgan Stanley, State Street, BNY Mellon, all took this unprecedented step of suspending their buybacks for Q1 and Q2 all at the same time. U.S. Bancorp also taking that action. Now, the main reason the banks is giving for this is that they want to be part of the solution this time, not the problem. And had they continued buybacks, it would risk painting the wrong image. They all maintain, by the way, that they did not need to take this action, that they've got plenty of liquidity, and indeed that the Fed's actions in the last week have made that even more certain, the discount window decision in particular. This didn't stem, by the way, from the White House meeting with the bank CEOs last week, but rather over the course of the last 48 hours, it became clear to the banks that the Fed was going to act in a large way last night. And this was sort of the banks' way of a sign of good faith to the Fed, as opposed to, say, the Fed demanding the action of the banks. Now, some bearish bank investors I've spoken to may ask why this collective approach and why via the Financial Services Forum, and possibly whether there's a weak member of the group that needed to be protected by the herd. But the messaging from all the banks and indeed the facts say exactly the opposite, that there's plenty of liquidity. Now, regardless, removing buybacks, Mike, as you said, will hurt earnings per share. It removes a potential hurdle for would-be short sellers. And, of course, rates are falling again today. So bank stocks are down sharply today and briefly earlier in the session went below Friday and last week's lows to be down 47% for the KBW Bank Index so far year to date.
If it wasn't the case necessarily that there was a single member of this group that needed or wanted to suspend buybacks, the collective approach does at least remove any potential stigma of perhaps banks announcing such things individually and piecemeal.
Exactly. It certainly does that. And I think that over the course of the weekend, as they started to discuss and wonder whether or not this should be an action they take, the balance was, in fact, either we do this and we don't make any announcement and we wait till our earnings calls in a few months' time when we're asked by analysts and we reveal that, and everyone will happen to reveal that, or we all announce it together. I think they came together to realize you couldn't have some announcing it and others not, because it would create that stigma. I think the other interesting thing, Mike, is that this change in the terms of the discount window, which will allow banks to add liquidity with unbelievable ease. They don't even have to reveal if they've done that for 3 years. So again, that's not something that will need to spook the market. But again, the only thing I think we would hear about if they did it is whether all of the banks do tap the discount window together at the Fed's request, and then there would be a big collective statement on that point. But as you said, so far this action removes the stigma of any individual action. I just point out, though, Goldman Sachs estimate if these buybacks are suspended for the full year, not just half the year, it would be worth about $80 billion that wouldn't be pushed back into these stocks. The collective market cap, where we stand at the moment for these 9 banks, is about $870 billion. So you're looking like a very sizable amount that's been removed from the market in terms of buying these stocks.
Hey, Wilf, watching JPM, which at 92 now is about $8 off the session lows. Any word at all on Diamond, the degree to which he is involved in what's happening?
Yes, indeed. So Gordon Smith and Daniel Pinto, the 2 co-CEOs and presidents, are very much running this bank, but I can confirm, according to a source, that Jamie Dimon was on the phone with them regularly throughout the weekend, and while Mr. Smith and Mr. Pinto are running the bank, Dimon was significantly involved in this discussion, and clearly all of the CEOs of those 8 banks that we mentioned were in touch with each other.
Wilfred Frost, we'll talk to you in a little bit. Thanks.
My pleasure.
Let's get to Eamon Javers in the meantime, get more on the D.C. response to the virus and what we might hear at this presser now at 3:30. Eamon, good morning.
Yeah, good morning, Carl. That's absolutely right. You'll notice that the 10:30 a.m. press conference has not happened. It's 10:45 now. They are saying at the White House that'll be at 3:30 this afternoon. No reason given here for the delay in the presser, but we do expect it to happen while market trading is still happening. So keep an eye out for that. Meanwhile, on Capitol Hill, Treasury Secretary Mnuchin said yesterday that they do expect to have to do a technical correction bill later on today. So we will watch for that. Meanwhile, in the Senate, we're hearing from leadership that they're going to be in at about 5:30 this afternoon. The Senate Republican leadership is suggesting they're going to focus on a FISA bill later today. And then also they're looking ahead to the next large piece of legislation here, which is going to, they say, be an economic stimulus package of some sort. No details yet as to what might go in that, and we'll wait for any information from the White House about what they might be announcing from the coronavirus. Of course, again, Carl, that will be at 3:30 this afternoon now, so we'll get some more guidance as the afternoon goes along.
And Eamon, just to infer from what you're saying there, so the Senate is not at this point planning to take up the House bill?
Yeah, we don't have any indication that the Senate is going to move. Well, the Senate is going to move on the House bill, but they're also going to move on their own bill that's subsequent to that. So the question is, will they make any changes? Where is that going to go on the Senate side? We don't know the answer to that just yet. We'll probably have more clarity this afternoon when we get senators in the Capitol and reporters have a chance to start peppering them with some questions. But as of now, we expect that they will move on the House bill and then follow up with that second round, which would be an expedited stimulus measure. But for right now, the president is putting his weight behind that House bill. He says he supports it. Secretary Mnuchin said the administration supports it. So we expect that that is going to persuade a lot of Republican senators to get on board.
Got it. Thanks for clearing that up. Eamon, talk to you soon. And joining us now is Morgan Stanley's head of public policy research, Michael Zezas, on the CNBC Newsline. Michael, thanks for calling in. Good to speak to you.
Good to speak to you.
How would you, I guess, characterize and rate what we've seen so far in terms of the Fed response? Obviously, we're going to see the fiscal coming down the road, but the way the Fed handled what it has announced last night and what's likely to come next.
Yeah, I think the assessment from us is that the Fed response was an overall upside surprise, but it's probably better in some areas than we thought and worse in others. The better than expected was on agency MBS purchases, the lower discount window, keeping the commitment kind of open-ended. Worse than expected was not necessarily getting the CP facility. But I think from our economist perspective, the important thing to keep in mind is until we got some credible sense as to when the disruption from the virus is going to peak, then Fed moves are more about kind of liquidity in markets than they are about the economy. And then you're supposed to be thinking about what the DC fiscal response is, as you were just talking about.
And what, at this point, how do you handicap what is going to be in this fiscal stimulus bill? And is it likely to be enough, at least from the market's perspective?
Yeah, I mean, that's the right question to ask. So I'd say, first of all, from our perspective, about a week ago, we kind of shifted and said having a fiscal stimulus response is not really a question of if anymore. It's kind of how and when. And I think the benchmarks we've set up is, what you want to see from a fiscal response here is it's got to send kind of two messages. One, it's got to send the message that people and companies aren't going out of business because of this, because they have to take safety measures. That sort of requires the targeted liquidity issues that you see in the House bill, temporary paid leave, things that we expect you might see, like business loans and tax breaks. And then, part two is you got to build faith in a V-shaped recovery. That means the kind of big fiscal expansion. It doesn't necessarily get people out of their houses in the short term, but it does put capital in the system so that the animal spirits are there for when this does pass. I'd say we're kind of agnostic on does that come in the form of state and local grants? Does it come in the form of tax cuts? We're agnostic on that as long as it's a big enough number.
Hey, Michael, it's Carl. Two questions. Maybe you can handle them both here. Is the Senate trying to make the perfect the enemy of the good, in your view? And are the Germans really getting religion on urgency here?
Yeah, so I'm far from expert on what the Germans might be doing here. And on the Senate, I'd say I'm an observer like everyone else. It's hard to know exactly what's going on in their internal process. I will just say that obviously D.C. tends to move slowly, but also these are kind of complicated issues to deal with, right? So for giving expansion and temporary leave, there really isn't a prior mechanism for that. So there is something you have to set up in terms of, are you mandating states? Are you pumping money to them to do that? Those are a little more complex than they sound. So some of this is just operationally fixing some of the safety net issues that pre-existed.
Right. But do you get the sense that response this time around versus the crisis will be less apologetic, where speed is more of the essence?
I think there's a good chance that that's the way it'll play out. Unlike the financial crisis, there really isn't much of a moral hazard issue here, right? You're not sort of rescuing folks from making poor decisions from themselves. I don't think that's really lost on anyone. And in fact, I think it probably helps speed things along, not that this is a good thing, but it probably helps speed things along when the OPEC Plus arrangement collapsed a couple weeks ago, because it sort of made the economic risks sort of acute and live in a number of states where representatives from Congress might have been resistant to thinking about economic impacts from the flu.
Any way to handicap whether this response is also going to mean targeted backstops of individual industries and things like that, whether it's airlines or something else?
Yeah, I mean, I'm watching the news just like you guys are. I mean, certainly there's some precedent for that from the response after September 11th. So I think it's something that is going to be considered.
All right, Michael Zezas, thanks very much for weighing in this morning. Appreciate it.
Thank you.
And let's check in with our Kate Rogers back at headquarters for the latest headlines on the coronavirus. Kate.
Hey there, Mike. Well, let's take a look at the number of confirmed cases topping 169,300 worldwide, with more than 6,500 deaths. Europe is now the epicenter of the pandemic. Beijing's strong measures to halt the spread of the virus, effectively slowing new infections for the first time. The total number of cases outside of China passing those that are now inside the country. Also, a press conference underway at this hour with the governors of New Jersey, New York, and Connecticut, the three states banding together where they feel the federal government is lacking to create a regional rule system aimed at stemming the spread of the virus. No gatherings of more than 50 people, and as of 8 p.m. tonight, all gyms, bars, theaters, casinos, and restaurants will close. Bars and restaurants will be moving to takeout or delivery only for now. And beyond the tri-state area, the CDC has recommended the cancellation of events with more than 50 people for the next 8 weeks. New guidelines on curfews and social distancing may come from the White House Coronavirus Task Force later today, with officials warning Americans to stay home. For live updates on the coronavirus outbreak, please check out CNBC.com. Back over to you.
All right, Kate, thank you. We'll see you in a little while. Let's get over to Rick Santelli this morning. Hey, Rick.
Hi, Carl. I'd like our special guest to weigh in on all these complicated issues of the day. Megan Green, senior fellow at Harvard Kennedy School, writes some great op-eds. We've all read her material. Megan, thank you for joining me today. Let's get right into it. You know, you started out your first sentence today basically going into recession is pretty much a fait accompli. Can you explain that? You know, down here in Chicago, we're calling it maybe a suppression versus a recession, because many think the demand side on the back end of this could be pretty swift at some point in the future.
It could do. Look, I think that whether we're going into recession or not is a question of epidemiology more than economics, and it's also a question of policy response. But that being said, the sudden stop that we've seen, the kind of demand side, supply side, and financial shock that we've seen means that there is a good chance that we'll have 2 quarters of contraction. The question really is going to be how deep is the contraction going to be and how long will it last? And that depends in part on how quickly we can contain the virus. And unfortunately, there's just so much uncertainty around it. We don't know that there's a natural peak for the coronavirus. But it also depends on our policy response. And the Fed, threw the kitchen sink at it last night. But this isn't really for the Fed to handle. The Fed has successfully worked out kinks in the funding markets. It's gone ahead and supported the banks. But what we really need to see is a massive fiscal response.
Now, considering that the Fed and some of the issues Steve Leisman's done great reporting on, you've written about, Article 13.3 and how things have potentially changed since Dodd-Frank in the last crisis. But at the end of the day, one theme continually comes up, and it's one of the issues I didn't have any problem with back in the credit crisis, some of these programs that really aid. And commercial paper is one of those areas. Do you see a need, and is the Fed going to have any issues, of course, getting Treasury to go along with some of those additional programs in the future?
I think it's almost inevitable that the Fed will have to invoke Article 13.3 in order to buy commercial paper, as it did back during the global financial crisis. Hopefully, Treasury will go along with it. I think there will clearly be a need to. That's how we're going to get cash to small and medium-sized companies that desperately need it. And so I think, we're going to get there. And I think Jay Powell sort of suggested that we would at the end of his phone or press conference by saying, this is what we've got right now. We have other tools that we're going to try to use if we need to. And I think that's one that is certainly first to come out.
Okay, now, Megan, this is a bit uncomfortable for me to get into, but I want to anyway. I think the Fed and all central banks have thrown much more at it than actually the issue warrants at this point, because we know it's a health issue, fiscal, getting money in people's hands quickly. But at the end of the day, my question is simple. Has our central bank in any way erred by basically going from 150 basis points of easing in a short period of time to 0 to 25? At the end of the day, many of my peers here in Chicago say, well, they can always take them back on the backside of this. I don't think that's necessarily a big possibility. Has there been some damage done for those who are nervous about 0 or negative rates in the grand scheme of things?
Well, look, I think you're right. It's going to be really hard for the Fed to take those rate cuts back. But I do think that the Fed acted appropriately in cutting rates all the way down to 0. And also in cutting the discount window or the discount rate significantly. I mean, by doing that effectively, the Fed has removed the effective lower bound. So, negative rates aren't an issue anymore for the U.S. if the Fed decides to use them that way and cut the discount rate into negative territory, much like the ECB has done with its TLTROs. And so, I think what the Fed is saying basically is over to you, Treasury Department. We're giving you rates at 0 for the foreseeable future. It's up to you to come up with a plan, and I think that's appropriate. It does mean that the Fed can't really respond with much more from here on out, and certainly not in the downturn. But, given that we know that a downturn is coming of some sort, I think it was appropriate for the Fed to have acted with such incredible verve last night.
Now, one thing has really changed this morning that I was kind of shocked at. Now, if you looked at where the back end of the market was, long maturities about an hour ago, they were under some significant pressure, and the yield curve, 10s to 2s, just as a generic barometer, toward the end of last week was, 47, 48. Then it dropped under 40. The long end's coming back. It's now down about the same amount as 2-year note yields, so they're both down about 13 basis points, and that spread is back in the high mid-40s. For your final thought, how much credence should we put in all the issues that have been thrown at our market? Because at the end of the day, for me, I'd rather see long-end rates start to grip. I think that would be a good sign in the grand scheme of things.
Look, I wouldn't look too long and hard at the shape of the yield curve right now, just given all the dislocations in the markets. I think what's important is that last week we saw both equities and treasuries sell off, and that's really weird. That suggests that there was significant stress in the funding markets. There were margin calls. A lot of companies were liquidating for cash, and there was a shortage of cash. And the Fed's gone ahead and addressed those issues. And, really, that's the best that we can hope for from the Fed. I think, when the yield curve inverted before, it wasn't necessarily a reflection that we were going into recession either. I think it was a reflection more of just kind of financial quirks. So I wouldn't worry too much about the shape of the yield curve this time around. I would worry much more about funding stress, and the Fed has said, look, we've got your back. We're absolutely taking care of this, and I think the markets find that credible.
Excellent. Megan, a real pleasure listening to your thoughts today. We're going to have you back, of course, rather soon as we try to get our GPS with regard to the coronavirus and its economic impact in the marketplace. Thank you for joining us today. Carl Quintanilla, back to you.
All right, Rick, we'll see you in a little while. Rick Santelli. Good Monday morning, everybody. I'm Carl Quintanilla at Post 9 of the New York Stock Exchange. Morgan Brennan is with us from CNBC Global Headquarters. John Ford helms our coverage from the floor of the NYSE. It's been another eventful Monday morning, as I'm sure you know by now. We did trigger a circuit breaker at 25.21. That was down 7%, went down right around 2,400, and then has since added about 100 S&P points as we are at 25.01 on the nose. Dow was, near 2025 and now 21.2. Interesting session, guys, as the day's far from over. But already, John, some headlines creeping out. For example, this one just now, Italy's Lombardy region posts its lowest number of new cases in a week. That's the kind of headline that the bulls are going to want to see.
Yes, indeed. And, I continue to watch the levels where we are trading.
John, are you there? Can you hear me?
I can hear you. Can you hear me? We're trading right around those levels after the plunge on Thursday, and a number of tech stocks continue to hold up decently well. But a lot of people's focus right now on how work gets done, how family gets taken care of here at the stock exchange. As we've mentioned already, coming in, we answered a questionnaire about how we're doing, making sure that there's no fever. We got our temperature checks on the way in. So precautions like this taking place in workplaces across the country, of course, and here on Wall Street to the extent that people are coming in.
Yeah, definitely. I mean, so many moving parts. It's such an evolving situation, not just a day at a time, but really an hour at a time, guys. Worth noting that in addition to equity markets and the big moves we've been seeing there, we've been seeing big moves in other asset classes as well. Copper, gold coming off today as well. Also, the energy complex, we're continuing to see some pain there. So with Brent and WTI trading lower, big move lower in RBOB and gasoline futures as well. That's one to watch here. Every sector in the S&P is in the red. Financials and real estate, the worst performers today. But another group to continue to watch, of course, is the transports, too. They're down about 7.6%, but obviously we've seen so much pain in the airlines and also some of those freight carriers as well, really on the front lines in terms of some of that real-time data where and people flows around the globe are concerned. Carl?
All right, guys, let's bring in Lazard Asset Management's head of U.S. equities, Ron Temple, this morning. A lot to talk with Ron about. Thanks for your time, as always.
Thanks for having me.
What's important for viewers to understand this morning, in your view?
Well, I think there are a few things. One is we still don't know how many people are truly infected with COVID-19. I guess the latest numbers from Johns Hopkins suggest almost 3,800. When we look at it, I believe that we're likely to find the true number is somewhere between 10 and 20,000 at this point. Seems like a reasonable number. And when I think about this kind of extrapolating out, the key point I'm focused on is where are the vulnerabilities in the healthcare system in the United States. And if we assume a doubling rate, which is basically a kind of fancy way of saying how many days does it take for the number of cases to double, of around 6 days, that means we could be at 434,000 cases within, say, 33 days if you're starting at 10,000, or at 27 days if you're starting with 20,000. The reason this is an important number is the U.S., based on our analysis, has about 21,700 intensive care unit beds available, or that could be called into service. If we typically find about 15% of people with COVID-19 need hospitalization, and 1 out of 3 of those people need an intensive care unit bed, at 434,000 units, we could be out of ICU bed capacity. So, importantly, by the way, the beds aren't special. What's important is that you have a ventilator because these are people in respiratory distress, and you also need healthcare experts who are trained to deal with these people. So that's the most important point we're looking at on the healthcare side right now.
Yeah, your language is striking in your note here, Ron. And I'll quote, while the Trump administration has either not grasped the severity of the situation or has not been honest about it to date, the Fed does appreciate the gravity of the disruption to the economy and markets. I guess on both fronts, White House response and now Fed, what's your grade?
Well, let's start with the Fed. I would give the Fed an A. I mean, I think the Fed recognized they did not have a lot of dry powder to work with. They also realized that if you don't have a lot to work with, you're better off trying to achieve a bit of a shock and awe to get the most bang for your buck. And what they announced yesterday, I think, was a pretty sweeping attack on the problem, and they're doing all they can do. So I give the Fed an A, and we can dig into that if you'd like more. But the Fed can't solve a coronavirus, and that really requires the federal government to basically be at the front on the front foot. And what's disappointing to me so far is, frankly, even the bipartisan compromise legislation that passed the House on Friday night has giant loopholes. If one of the key intentions of the legislation was to make sure that people who are sick don't go to work and infect other people. But the legislation allows exemptions for any company with over 500 employees and allows for an application for hardship exemptions for any company with under 50 employees. Well, that's 80% of Americans work in those companies, which effectively means you're making people choose between putting food on the table or potentially spreading an infection. And if I look at the press conference on Friday at 3:30 from the White House, what was disappointing there is it quickly became apparent that the website for a national database that supposedly was being worked on by Google wasn't accurately portrayed. And also, it's great that these companies are offering capacity in their parking lots for testing, but it also still isn't clear who's going to be responsible to roll out that testing and when it will be available. So I think what we realize is the federal government has either been not aware of the situation or has been too focused on politics to make people aware. And this is really important. For people to understand the importance of social distancing, they have to be told the truth. And they have to understand these issues around ICU capacity and effectiveness. And I worry that we've had 2 months that have largely been wasted in terms of communicating that message.
Yeah, Ron, I mean, certainly there's a lot of different factors that are playing into all of this right now. And we know from Peter Navarro on our air earlier today that you're going to start to see some executive orders drafted around some of those things like medical supplies, for example, coming back to be manufactured here in the U.S. as well. So we're going to have to see how all of that continues to manifest. In the meantime, I want to get your thoughts on the market specifically. The fact that we're seeing, I guess I should say, the behavior that we're seeing manifest across different asset classes right now. The fact that you would have equities selling off, but also gold selling off here. I mean, the Treasury market specifically has been used as a gauge or a signifier for behavior or correlations across other assets. And we've seen that essentially break down in the past week as well. Do you feel like there has been, I guess, a disentanglement or that relationship has been compromised?
Well, I think
over the weekend, and it didn't matter the time of day or what the store itself was. They were very busy, and it was very specific items across those different stores that seemed to be sold out. What are you seeing in your Stu Leonard's locations right now?
Well, we're definitely seeing panic right now, and we've seen that for the last really 3-4 days, really since Trump gave his speech that first night. And everybody's out there worried right now. They want to get food. They want to stock up. We've seen water fly out of here. We've seen paper towels. And the thing that amazes me is toilet paper. It's one of the biggest sellers. But, you know, one of the things I did, I mean, they're buying things like this now, like fresh squeezed orange juice, because you can freeze it. The meat right now is literally, everybody's buying it. You can freeze it. You know, we have these even fresh fish or salmon like this that's all frozen. This stuff they're just gobbling up and putting in their freezers at home. So you're seeing a lot of people buying product and freezing it, and then you're seeing the hard goods and staples like water, cereal, paper towel, tissue, all that. They're really filling their carts up with it.
Yeah, how concerned are you about supply chain disruption or the potential for that here? How quickly can you get some of these items back on store shelves?
Well, one of the things we've been very fortunate about is we buy direct from the suppliers. So the producers, the farms, we get direct loads from them. So we've been really lucky right now to get food. And as you can see, we got plenty of food here at Stu Leonard's, fortunately. Makes me feel good. We've been in business 50 years, and we're supplying our customers and giving them what they want right now. But we're seeing some disruption from California right now. It's getting tight out there. They also just had a little bit of rain, which hurt them a little more. But we have other sources of fresh fruits and vegetables that we can get. We've also seen a little disruption with salmon in Canada and the Bay of Fundy up there, but we're able now to, we're bringing up some salmon from Chile. I think most of your retailers, if they get the distribution part of it down and can get the products out there, we just have to get it in the stores. Except for a few items like toilet paper, Purell, masks we cannot buy on the market right now. You can see even Amazon has run out of a lot of things online. So, but it's mainly the fresh basics that you need. We feel there's good supply, and we'll have them here at Stu Leonard's.
Stu, I'm wondering about what's the smartest way for people to shop that would actually be helpful to you? Should people be ordering delivery instead of coming in? Are there practices that you wish people would employ to either shorten lines or get what they need more efficiently?
Well, you know what I'm finding, and I've been on the floor, you know, I was out in Long Island yesterday at our Farmingdale and East Meadow store. There's a range of people's acceptance of the coronavirus. Some people are not worried at all, and they're just saying, I'm going about my daily day. Other people are petrified. So what we've done at the store is we're wiping everything down every hour, from the bathrooms to the registers to the keypads, pens. We're giving everybody a sanding wipe. I was in Costco. They were giving me a sanding wipe when I walked in. We have lots of Purell bottles around the store right now. So what I would just recommend everybody is I feel we're doing our best job keeping the food safe, keeping our workers safe. They're all trained in food science. They're wearing gloves all the time, teaching them about keeping some distance and just using good hygiene all day long. I'm washing my hands like probably everybody watching today. I'm washing them maybe 20 times a day now. So I think taking normal precautions every single day is the way to go right now. I wouldn't be, personally, I don't think you have to be freaked out right now and say I can't go out of my house.
Yeah.
That's my own personal opinion. Other people are different.
Yeah. Stu, I'm curious what you make of some of the response efforts that are coming out of the federal government right now. I mean, as the owner of a medium-sized business, something like a payroll tax cut, for example, how much would that help a business like yours in this time of uncertainty?
Well, I think it would help, and definitely I feel really bad for a lot of people. Like, look at all the restaurants right now that just got closed. We're a family business here, and I really feel for that, because that's probably some family right now that had to close their restaurant. And they still have rent, they still have electrical, they still have all these expenses, and it's really putting them into hardship. And I think the federal government really has to do something to help that, not business, but family out at a tough time like this right now.
Stu Leonard Jr., thank you for joining us today.
Okay, thank you.
Meanwhile, the work from home plan is hitting some glitches. Some Apple workers have found they can't do their jobs remotely because of the security software installed by Apple to fend off outsiders. That, according to the Wall Street Journal. Google also sent home 119,000 employees, and now it's reportedly getting overrun with requests for remote working equipment, computers, cables, printers. Real challenges are in store, and Contessa Brewer joins us via Skype from home, perhaps, with more.
Well, John, I'm actually at the home of CEO Martin Smithmeyer of AmeriCord Blood Services. They collect umbilical cords and right now are working on stockpiling stem cells. And he, like millions of other Americans, is trying to log on from home. 100% of his staff right now working remotely. And they're joining, of course, the college kids. They are joining the elementary school kids, everybody trying to get on at once, which leaves us with a few big challenges, right? One is capacity. Picture the Lincoln Tunnel. If you've got very little traffic going into the tunnel, everything is smooth sailing. You take a whole lot of cars and try to shove them through the tunnel, and all of a sudden you've got a 2-hour slowdown. And then if you are connecting to your corporate devices via VPN, that is a secure tunnel which connects your devices to your corporate network, that's likely experiencing massive slowdowns. In fact, Atlas VPN shows usage in Italy grew by 112% last week, and in the United States, it grew by 53%. Now, interestingly, Verizon tells us it's not seeing a significant uptick in internet usage. Let's see if that changes this week. But in Italy, we know that Telecom Alitalia actually saw a 53%, no, that's right, the number here, 70% increase in internet traffic. The head of that telecom says that was all Fortnite. The other big challenge at working from home is security at this point. Cybersecurity experts say we don't always practice the best digital hygiene at home. So for instance, take a look at the text that I got that was a smishing text. If I look at that, I sent this off to Checkpoint Security and they told me, hey, that text is actually from a malicious actor. If you go onto it, it would be an infecting website. What's more, according to Checkpoint's threat intelligence, there have been 4,000 coronavirus websites registered since January, and they are 50% more likely to be malicious. So what is good digital hygiene? A strong password for your devices and for your Wi-Fi. You need strong security software with multi-factor authentication. Your corporate devices are safer than your personal cell phone and laptop. And then you have to be aware that because we're working from home in emotional times, it makes us all more vulnerable to phishing, or in my case, they call it smishing. You know, that's that SMH, smishing kind of thing. I wanted to ask Marty a question here. Marty, you told me that, in fact, you were concerned about working from home because of productivity. Can you explain to me how you think this is going to work? What are you looking for when it comes to productivity?
Yeah, good question. So what we found is that in the past, when we tried this, some folks work really well at home and others really struggle with it. And so we've been really setting up a lot of remote tools, Slack, Zoom, video conferencing, conference calls. We have daily stand-ups, and we're looking for what are the daily metrics that we expect to get done for the day, and are they actually happening?
You also had a big global conference call with your CEOs that you're on this big group with. What are the CEOs in Italy telling you about preparing for this?
Yeah, great question. This is I'm part of EO International, which is an entrepreneurs organization, and they had a conference call with leadership in Italy, and the message was get ready, it's coming, and it's likely what's going to happen here is going to look completely different from what we have right now in 2 weeks.
All right, so that's Marty. So you can tell that my Skype skills need a little help here, but if this is the new reality of working from home, I'm going to work on that. Morgan?
I don't know. I'm pretty impressed, Contessa. Thank you for bringing us that.
Thank you.
The amount of Zoom invites my family has gotten for school and everything else. else. It's through the roof. All right, Contessa Brewer. Let's turn back to this morning's massive drop in stocks, though, specifically those in tech. RBC's Mark Mahaney and Krish Sankar Cowan join us now. Good morning to you both. Krish, I'll start with you. Specifically, Apple. We've spent the better part of this year talking about the China impact as we saw coronavirus affect that country on Apple, where that country is concerned. But now that you have retail stores there opening back up, but retail stores in the rest of the world for Apple closing, what does that impact look like?
Sure, Morgan. Thanks for having me. And it's a very good question. I would say a month ago, when this whole thing started and Apple's been announcing on President's Day, it was largely China, tied to China, and more importantly, the supply chain. And what you've seen over the last 1 month is the supply chain in China is actually coming up to speed, with our fieldwork suggesting that, these are issues about 50% compared to 25% a month ago, and they're trending towards getting to 90 to 100% by the end of the month, which is positive. So now the focus shifts to demand, and like you rightly pointed out, the concern with the supply chain last month was demand in China, and now it's slowly expanding to demand in the Western world, and we think there will definitely be impact on that. It's very hard to quantify today where we are sitting, but when we did an analysis, we tried different scenarios looking at current consensus numbers all the way to down 3% here for Apple, assuming the global demand gets impacted, especially on the hardware side because of the virus.
Yeah, I mean, to that point, Krish, and it's something that I keep coming back to, but is there any way to get your arms around what that demand picture could look like for things like our iPhones and other luxury electronics that Apple is so well known for? I ask that because if people are losing their jobs or they're foregoing paychecks, maybe they're not feeling so confident, we see the economy go into recession, are they going to be as willing to spend that money or move into another upgrade cycle?
Very valid point, and it is a tough one to answer, but one thing I would say is that the way we looked at it was, prior to this whole virus situation, I think the iPhone unit numbers were tracking north of 200 million for calendar 20, and now we are assuming a worst case scenario if it goes down to around 180, 185 million units, which would probably trigger rise on the replacement demand level, because if you look at the install base of iPhone, just around 1 billion units, maybe it's shy of 1 billion units, and in a 5-year replacement cycle, it implies 200 million units per year. So at 185 million units, you're just below what I would characterize as the replacement unit level. So anything else beyond that would suggest to you, people prolonging. So in other words, if Apple ends up shipping close to 185 million units, it's down from what it was pre-virus, but it does assume there is a certain amount of replacement demand happening. Anything below that, I would say, below 180, 185 million units, it implies people are holding out and not willing to switch phones at this time.
Krish, along those lines, how are you modeling Europe? Because I'm thinking not just about Apple. I'm thinking, for example, about Huawei, which is doing a lot of business in Europe on handsets on the consumer side. And when you've got not just Italy, but also Spain and France starting to place all kinds of restrictions on what kinds of stores are open, how people can shop, I'm not sure there's enough delivery available for people to buy phones and equipment, even if they wanted to still buy them at a time like this when there are such concerns. So how much reduction in demand for electronics in general, maybe Apple specifically, are you modeling, and how long do you expect that demand to be suppressed?
Sure. So I think on Apple, I would say that overall right now, like I said, we had originally like 202 million units for iPhone this year. They've gone all the way down to 185 million, give or take. So that's like roughly like a 10% cut. On Huawei, I think Huawei is slightly different because the reason is, John, you have a very valid point. It has some share in Europe, but I would say that ever since the U.S.-China trade wars last summer or 2 years ago it started, and the ban on Huawei since last June, I think some of the demand in Europe has waned. Huawei largely is a China-only brand today. Or I would say more than 70% of their units goes into the China market. So I think from the standpoint, they're probably slightly insulated. But I think to your point, I think it's more a question of Apple and the other brands, which will have an impact from Europe. But right now, we're assuming a 10% haircut to iPhone units. And also keep in mind, this assumes that demand does slowly start coming back in the second half, and calendar Q2 numbers are going to be really good. And I think the stocks are already discounting that. We have to take it on a month-by-month basis to see if the demand collapses beyond Q3 or Q4.
Krish, finally, balance sheet health. I imagine Apple's in a league of their own, but beyond that, who's at the top?
Absolutely. I mean, that is one good thing for Apple. Solid balance sheet. I think the cash flow should still be strong. It's kind of interesting. Last week I spoke to a couple of investors, and they acknowledge that Apple is probably in a better place than many other stocks. So I think they like it. But this is unfortunately or fortunately, this is a market which is shoot for question traders, and valuation metrics don't really matter at this point. It will probably start coming back to matter at some point, and balance sheet strength will come back into questions. But that definitely is a silver lining for Apple, given all the issues that we're seeing on the consumer front.
All right, Krish Sankar of Cowen. Outperform rating on Apple, price target 370. Thanks for joining us.
In the meantime, let's get a news update with Sue Herrera back at HQ. Hi, Sue.
Hello, Carl. Hello, everyone. Here's what's happening at this hour. The White House has new measures to protect President Trump and his staff during the coronavirus outbreak, including taking the temperature of anyone who enters the complex. In the press room, social distancing is being implemented with signs posted on seats that are to be kept empty. The Supreme Court is suspending some operations due to the coronavirus. It has postponed oral arguments through the end of the month. The Supreme Court has been closed to the public since last week. In France, the automaker that builds Peugeot and Citroën vehicles will be closing its factories in Europe until March 27th. The company cited the spread of the virus, disruptions in its supply chain, and a sudden decline in auto sales. Here at home, Scholastic has set up a free Learn From Home website for kids who are stuck at home without school. Content is divided into 4 categories. Scholastic says each section already has a week's worth of content with 15 additional days on the way. That could be a game changer for parents. That's the news update this hour. John, I'll send it back downtown to you.
Yeah, Sue, we all need all the help we can get.
Exactly.
For more on today's massive market drop, let us bring in economist and former PIMCO Managing Director Paul McCulley. Paul, you are cheering the Fed's move to cut rates to zero. I'm also wondering, though, is the market, you think, correctly pricing in the domino effects of so much of business, of small business, being effectively shut down for several weeks, and the businesses that might go out of business, the employment challenges that many of the American consumers might face?
I think the Fed categorically did the right thing. They threw a mosaic of everything they had at the immediate moment. So you get zero criticism of the Fed, but the equity market is actually discounting the uncertainty so they know the direction on the real economy. So I don't think there's any sort of indictment from the equity market of what the Fed did. The equity market is looking at the real world, and the real world is going to require a lot bigger response than just the Fed doing everything they can. It's going to take a fiscal policy response to literally get money in people's pockets. That is the bottom line. The Fed can get money into Wall Street's plumbing system, and they're doing it with alacrity. But the bottom line is we need to get money, hard, cold money, in real Americans' pocket, particularly the most vulnerable amongst us.
Absolutely, Paul. And that's what I'm wondering about the consumer, which has been so important to this economy, certainly to these markets. Where the markets are right now, is that kind of helicopter money being priced in, or is this pessimism or fear about the uncertainty on whether that kind of fiscal is coming?
It's interesting you mentioned helicopter money, because what the Fed did yesterday wasn't helicopter money. It was conventional monetary ease down to zero, plus a huge amount of QE to try to restore functioning in the marketplace. But it was not helicopter money. A helicopter money would be essentially granting Treasury overdraft privileges on its account at the Fed, which was effectively actually the Treasury could use printed money and get it to the people. So we're one step away, I think, from helicopter money. The Fed can't do that itself. It would require an act of Congress. And in fact, as a citizen and as an economist, I would be in favor of that. But I really want to stress that there's a huge difference between QE, which is dealing with liquidity and market functioning, and helicopter money, which is essentially the fiscal authority telling the Fed that send out checks and we'll run an overdraft on our Fed account.
Yeah, I mean, key point right there. I just want to dig into this a little bit further, though, because the tools that we've seen the Fed basically unleash in this unprecedented manner in terms of timing so much over such a short period of time really in some ways harkens back to 2008. These are the tools that were used for a bank solvency crisis. Are they actually, do we know that they're going to be effective tools for what is a pandemic and what is right now a liquidity panic?
The Fed can do a lot of things on liquidity. In fact, the next one they need to do is to do a commercial paper funding facility like they did a dozen years ago, which I was involved with, which actually restored functioning in that market. And that is a connectivity to the real economy, because you have companies that have to continually roll over their commercial paper, and their natural buyer, particularly money market funds, are not buying longer dated commercial paper. So we need a buyer of last resort for commercial paper, and I think that will happen probably within the next 24 hours, hopefully. So the Fed can do that from the standpoint of keeping companies that issue commercial paper from facing a liquidity crisis. But fundamentally, it is now all over to the fiscal authority and Congress essentially taking the lead in getting money into people's pockets, and if necessary, and I think it is, changing the law so as that the fiscal authority can direct the monetary authority essentially to grant the fiscal authority a overdraft privilege.
Yeah, Paul, that's what I want to ask you about in terms of the political realities of that actually happening. What kind of odds do you give it? And to what degree do we need to hear Powell, even academically, bless sort of the Rosengren school of thought that we heard last week or the week before?
I think Mr. Powell is doing a fantastic job, so I'll be the last person to criticize him. What he did yesterday and what he's done in recent weeks has been superb, and I certainly think that he is encouraging the fiscal authority to step up to the plate big time, and I think he will be cooperative to the max. But I think also appropriately, he doesn't want to take the political lead in telling Congress what to do. He's just basically saying, you have scope to do what needs to be done, and damn it, get it done.
Paul, how important is government communication right now? And I'm talking not just about the economy in general and what they're going to do about that, but also public health and protocol, because we've heard a number of different messages from the White House, from Washington, over the past few weeks about this being like the flu, not being like the flu, social distancing, not social distancing. Perhaps they're getting more consistent, but hey, it's only Monday. How important is it for the government, both federal and state, to get consistent in messaging?
I think it's absolutely critical. We're dealing with radical uncertainty on the part of our citizenry because we've never dealt with something like this before. And when you have radical uncertainty, you freeze. And it is incumbent on our government to provide information that is robust and correct, and also where they don't know to say they don't know. And here, in contrast to Chair Powell, I would say Mr. Trump has been a lost ball in deep rough when it comes to communication in recent weeks.
Paul, I realize that this might still be early days to even be asking this question, but how long would you expect rates to stay at zero? And I ask that because if the expectation is that this is a pandemic, a crisis that's going to last for weeks or potentially months, what will it take when it actually passes for the Fed to start basically restocking its arsenal?
I think we're down here for a very long period of time. I don't think the notion of take back once we get on the other side of the V is got any legs to it. Remember, going into this whole crisis, the Fed had missed its inflation target on the low side for essentially a decade. The Fed wants this economy to come back really strongly and also for inflation to go up. So the whole notion of then they'll come down here to zero and then, in a month or two, take it back, I ain't a buyer of that whatsoever. We're down here for a very extended period of time. Remember, the last time we went to zero, we stayed down there for 7 years. I'm not forecasting 7 years, but any notion of a quick take back is something I think would be wrong. And also, I think the Fed recognizes it would be wrong and would push back on any expectations of that concept developing in the market consensus.
All right, we will hunker down, as many have been saying in recent days. Paul, thank you. Paul McCulley, former chief economist at PIMCO.
Got the S&P down 6.4%. Session low was down almost double that. Apple closing all of its stores outside Greater China as the coronavirus spreads. Our Josh Lipton's in San Francisco with all the latest. Hey, Josh.
So, Carl, Apple really surprising investors with that decision, deciding to close all its stores outside of Greater China until March 27th. Remember, Apple has spent a lot of time, money, and effort to build out this network of stores. Sometimes we just kind of forget how big that footprint really is. In total, Apple now operates a whopping 510 stores around the world, 271 here in the United States alone, 52 stores in that Greater China region that will remain open. That's an operating segment, remember, that includes China, Hong Kong, and Taiwan. Apple's online stores do remain open. In a letter posted on the company's website, CEO Tim Cook writing that the most effective way to minimize risk of the virus's transmission is to reduce density and maximize social distance. I caught up with Gene Munster over at Loop Ventures over the weekend to get his take just on the financial impact of this decision. By his math, Munster's estimating that Apple's hundreds of retail stores account for 8% of total company revenue in a given quarter, and that if the stores do remain closed only until March 27th, as expected, then this decision impacts, he says, revenue in the current quarter by about 2%. But I also did catch up with tech analyst Ben Beharin. Ben is a longtime Apple watcher, just like Munster. He says there's a much bigger concern for investors right now, which is as consumers get more worried about the virus, about the economy, do they now pull back on discretionary spending? How much, in other words, do they hold off on buying those new iPhones, watches, and AirPods? Guys, back to you.
All right, Josh Lipton, thank you. I know in my household, for one, with a couple of kids staying home from school, I'm thinking, do they have the right iPads? Do they have the right laptops to get work done? There might be, at the same time, some other decisions like that being made. Great report. Thank you, Josh. Let's stay on the topic and in Northern California now, talk about the challenge of leading through a pandemic for tech CEOs who have perhaps been in that seat for less than a decade. Kara Swisher joins us now. Kara, good morning.
Hi, how you doing?
I am doing fine, thanks. I hope you are as well. So it strikes me, Kara, that even though there's all of this technology for exchanging information over a distance that comes out of Silicon Valley and modern tech companies, the place itself has a lot to do with interacting face-to-face, whether it's these open plan offices, the roads are clogged because people are trying to get to maybe the spaceship headquarters that Apple has in Cupertino or Google's campus where normally the cafeterias are open. How big a shock is this to the culture and operation of tech in Silicon Valley?
Well, for digital people, they're very analog. I mean, as you know from being there, they go into the office a lot. Their offices are mini campuses. It's where people live and work. They do their dry cleaning. So it's a big change not to gather. So I think that's one of the things that, even though tech, they use a lot of these devices, they are a very gathering kind of culture. To me, I think they've done a pretty good job being very early to announce closings of companies, being very early to announce focusing on their employees, which these companies have always been, and doing a range of things that they are supposed to be doing, like Facebook cleaning up issues around misinformation, which they've been doing, which of course is the lowest bar. They should be doing that as a matter of course. or giving money. You know, Mark Zuckerberg pledged a bunch of money donations, so did Google. And so there's all kinds of things they're doing, including just getting out good information to people and creating an ability for people not to feel adrift. And so for themselves, it's for themselves as well as others.
Yeah. Well, as we're having this conversation about technology, where I think we're having some technical difficulties with the connection right now. So, Kara Swisher, we're going to come back to you in just a moment. In the meantime, let's head out to Chicago to Rick Santelli at CME Group's global headquarters in Chicago. Hey, Rick.
Yes, global headquarters. We don't hear all the other voices, but you know what? Trading floors are wonderful, but the fact that we're up and running at all and markets are fluid is a good thing. Let's start out with the main issue I've been paying attention to. What's going on with that relative value trade? All the yields around the globe, of course, when our Fed basically goes 0 to 25, rates have come down. It wasn't shocking to see them come down yesterday on the announcement. The difference between our 10 and the German 10, 131 basis points, as you see on this chart. That's the closest they've been, basically, in 5 years, going back to January of 2015. And I think that is very significant for a number of reasons, because ultimately, when there is some sort of normalization in the world, we need firmer rates. Europe needs healthier banks. The fact they're getting closer together isn't necessarily a bad thing. Now, 10s minus 2s, it's been all over the place. Now, right now, in the upper 40s, it's hovering around 47. It's virtually the steepest it's been since May of 2018. About 2 hours ago, it was under 40. The long end has been very volatile. Finally, in my opinion, the dollar index is a good tell. It's a good market to pay attention to. Many people are scratching their heads over gold and Bitcoin and all the safe harbor trades. What's a safe harbor at this point? And how long does that safety last? We've discussed it. If you were in the market at 31 basis points on a 10, 69 basis points on a 30 at their all-time historic intraday lows a week ago, you're not feeling that that was a very accommodating position, although it's been more against you than it is now. But the dollar index, on the other hand, don't think of it as a safe harbor. What it is it is in big-time demand. Many countries and economies around the world, the ones that find the most nervousness when we get these global macro exogenous shocks, they need dollars to fund all their obligations. So basically, we traded down just under 95. That's the low close, but it's bounced. So currently, with the dollar index hovering above 98, currently close to 98 and a quarter, what I want to put across is that if you look at this 95 area, that is a good area that most likely we've had lots of key bottoms and tops, lots of consolidation above and right there. It is home base. If we start trading below that, the rest of the world might be happy, but I don't think it's sustainable. I think the demand continually comes back. We did test within a dime of 100 just 4 weeks ago. That doesn't look for a range between 95 plus and 99 plus in the dollar index. And if we go above it on this side, it won't last long, but it would be vicious. And if it goes below here, it would be a slow melt. But ultimately, this is the place it should hold. Carl, back to you.
I will take it, Rick, between 95 and 99. Thank you. We will watch that. I'm going to try again with Kara Swisher, see if we got a better connection this time. Kara, want to ask about the impact of this on tech's perspective toward the rest of the world, particularly the government here, because President Trump called out Google specifically, saying it's going to help with this website. All kinds of questions about exactly how much Google had planned to do that before the president said it was going to happen. But Google had been criticized for not helping out as much with military things as the president would like. Is this an opportunity for a different stage of cooperation between tech and government?
Yeah, I think so. I think government, you have to separate Trump from government in this case, because I think tech, it really is moving forward with all kinds of parts of the government to try to get information out, to try to minimize misinformation, to get rid of price gougers and things like that, and buy products. So in that case, in this way, they're working very hard. They met at the White House last week, as you know, tech leaders, and there's all kinds of things they can do. I think that one of the things that's critically important to remember here is that, when these companies do rise to the occasion, they can do a lot of great things. And they can, again, just at the very base, provide great information for people who are stuck at home or provide great technology. So I do think you'll see a lot more cooperation between these companies It doesn't, between these companies and the government, it doesn't mean some of these issues with these companies is going away. There were still hearings last week about antitrust. There's still issues around, all kinds of issues around big tech. But I think for right now, it will go on hiatus until this crisis is over.
Mentality-wise, Kara, how do you think, and maybe it's too soon to tell, we're still very early days, but how do you expect a crisis, a shock like this to affect the Valley? I mean, we both lived through the dot-com bust, which I would argue had a much bigger impact than the financial crisis did on the West Coast. How heavily is this going to weigh based on what happens to valuations, delayed or scuttled IPOs, attitude toward risk?
Well, you're going to see the IPO scuttled. I mean, there was going to be Airbnb and others, and I think Airbnb is taking a big hit here with travel and things like that, and so it's probably unlikely, or so there's some delay in their IPO. Other companies like Apple, of course, which have a lot of retail operations, they're exposed in that way. It's not a huge amount, but it's an amount, including discretionary income spending on things, so they're going to be affected. Other companies like Zoom and others that create these products could do really well. Even Amazon with delivery, when people really start to using delivery and start to like it, they could benefit when this is over as people begin to change their habits. The other thing is working at home, the idea and products that help you work at home. People might like this kind of format or get used to it as this thing winds down in months to come, hopefully. So it depends on what company you are. But in general, I suspect Silicon Valley will be just fine coming out of this in terms of the tech tools they provide to people and people getting used to living a digital lifestyle.
Yeah, Kara, to that point, we've also seen a lot of these big tech companies, Google included, making bigger pushes into the healthcare sector as well. And I realize Verily has been a source of contention and controversy over the weekend, but we are starting to see some of those services launch, at least in a very small, limited way, I think in 2 counties in California. But how does this propel or maybe even spur faster some of these pushes into this area?
Well, they have to. I think it's really clear that part of this is that the healthcare system continues to be problematic for most citizens of the United States, so we can't get things out quickly, and healthcare is not available to everybody. And depending on, no matter what side of this you're on, you want better delivery of healthcare to people. And you can see, like, one of the things we talked about on my Pivot podcast was, what if Amazon was doing the testing and delivery and things like that? What if some of these companies that are really good at logistics get involved in healthcare? Because I think this is an area ripe for disruption, and I think this crisis is going to show people how much the healthcare area does need to be innovative and to think of better ways to deliver its services to patients and others.
Hey, Kara, prior to all this, our conversations were often about Facebook and the degree to which they were not willing to step in and make a judgment on the veracity of something that was on their platform. Whether it's Facebook or any other tech company, we're going to see changes to that policy in the national interest. Could you envision a Facebook that says to all users, look, there is that rumor about national curfews or what have you is absolutely not true?
Yeah, I think it's interesting because Mark Zuckerberg gave a very rare interview to Ben Smith of the New York Times today, where, of course, it was a little bit of a victory lap. They said, hey, we're going to take off bad medical information. To me, that's the lowest bar they should reach. This should be something they do without even pausing, getting rid of bad information on any platform. And so, they certainly are. What it does show is they're certainly capable of taking off information and making decisions, editorial decisions about bad information. I think it should apply to everything all year round and not just here, though I absolutely think it should apply here. And they have been moving very quickly to give them some credit, but also it's what they should be doing in the first place. And so, I think they've been very clear that I think he was calling it a black and white, an easy black and white decision. Well, it is an easy black and white decision to protect the health of all Americans and people across the globe, but it should be a black and white decision to have accurate information on the platform on any topic all the time.
Kara, finally, I want to ask you about events and conferences. Google canceled I.O. effectively. Apple moved WWDC to being digital only. You participate in and host quite a few of these yourself. What do you see happening to those traditional tech gatherings?
I don't know. We're going to be delaying ours. We'll be announcing that to first the audience later today, I think, or tomorrow. But, we think it's really important for the health and safety of not just the people that attend the conferences, but the speakers and our own staff. It's really important to do so. I think they'll come back eventually. I don't think we're going to do all these only digital conferences. As you know, as I said, Silicon Valley is an analog place as much as it is a digital place, and a very analog place, actually, compared to many, many industries. And so you're going to see those gatherings coming back, and I think it's critically important that people interface and network and know each other. And, life eventually will return to what the next normal, I guess you'd call it. And we all will have some important lessons to learn about these kind of crises. But I think they'll eventually return, but not for a while, and not, at least into the fall, if not longer.
Yeah, good point, Kara. These things do change us, hopefully in positive ways. Kara Swisher, thank you.
Thank you, John.
Meantime, professional sports leagues around the world shutting down due to the coronavirus. Seasons are flat out canceling their games and tournaments. With us now on the virus impact on sports, legendary MLB agent Scott Boras. Scott, thank you for the time today. We're grateful.
Good morning, Carl, Morgan, John.
What is the calculus right now inside the league? For the sake of these media companies who relied on this live content, can you envision games without crowds, say sometime before Memorial Day?
I think that the first thing is that sport provides, particularly baseball, provides kind of a daily life type of involvement in a household, and I think the most important thing is a return to normalcy. And if we can provide people that we're in kind of a stay-at-home mandate now, that's, I think, best for everyone. And I think that initiating sport in a way where we can deliver it to homes will be a good first step, and something that I hope that we're kind of using the model of Shanghai as a method to understand a little bit about, because they're ahead of this. They're through the waves that we have yet to go through, so we can kind of see what they're doing with Disney reopening there, and potentially their basketball leagues opening, and after a shutdown of a period of time. So I think those models are going to be helpful for us.
Yeah. What's the mood among players? Are they anxious to play, nervous to play, somewhere in between?
I think it's very difficult for baseball, because in the NBA and the NHL, they've already played like 80% of their season. For ball players, what we're doing with our own internal training staff, we're trying to making sure their environments are following CDC recommendations. And, of course, I think the clubs have done a good job of allowing places for players to train, and while following recommendations and carrying out a professionally isolated environment, having healthcare professionals near them, I think is really valued. But it's a difficult time, because you're ramping up for something, yet there's a strong interruption, and you want to do your best to aid your families and everyone around you in following proper protocol, for the CDC to evolve through this correctly. But also, there is a real demand on the athlete to stay where we know that button is coming, and they have to be ready to go, and they're really ramped up for the seasons and have spent the last 4 or 5 months getting ready for the season. So psychologically, it's a very difficult time to go on a hiatus for Major League players.
Yeah. As far as support staff, arena workers, we've seen some really generous moves by Mark Cuban, Williamson, obviously. I wonder what you think the responsibility is among owners, franchise presidents, and so forth, GMs, to support the industry surrounding the games.
I think all of us who employ people that are in a sport that is relatively shut down, I think it's important to make sure that we're going to have, particularly in baseball, we're going to want to do the best we can to make sure that everyone is operational as soon as practically possible. And to do that, we cannot lose employees that are trained and are familiar with the environments of operating the game efficiently. And I think that, we have to invest in that, and we have to make sure that all of our employees are prepared and ready. And a consequence of that, I think, is making sure that they have dollars in hand to allow their lives to get by, and yet knowing that we have to look at this. It may be 40 days, it may be 60 days, whatever that period of time is, that all these employees are going to be back at work and be called upon to do what they've been trained to do and create a product and an environment that is at a level that it was before.
Yeah, Scott, coming off a weekend where the NFL players just ratified a new labor deal, I wonder what you think this is going to mean for... Oh, all right. Actually, I'm going to have to stop myself right there. We've got some breaking news. Scott Forrest, thanks for joining us. Steve Leisman, we're going to get over to you for these headlines.
Morgan, thanks very much. The New York Federal Reserve announcing it's doing an additional $500 billion in overnight repo. Typically, the Federal Reserve does just one of these in a day. It did one this morning. $129 billion was taken down. Apparently unsatisfied with the functioning of the market, the Fed coming in with an unusual second repo, $500 billion of overnight repo. I don't think the 500 is the number to focus on. I think the idea of the Fed is saying to the markets, as much as you possibly need is what we're able to provide for you now in terms of overnight repo here. It's one of several operations the New York Fed is executing today, including going into the market purchasing $40 billion of additional Treasury securities and agency mortgage-backed. It did an $8 billion offer this morning. $21 billion in bids was submitted, an indication that there is tremendous demand out there for the purchases the Federal Reserve is making.
All right, one more important incremental news flash that we've gotten today. Steve, by the way, I should mention session low on the Dow was down 2,800, and we're currently down 1,600. Steve, I wonder, given the announcements we've heard from the Fed today and over the weekend, what's important to listen for when the White House speaks at 3:30?
Well, you know, Fed Chair Jay Powell yesterday repeatedly said that the monetary policy was really in the third tier of responses, he believes, to this coronavirus issue or crisis. He said it was public health in the first instance, fiscal in the second, and monetary policy in the third. So I would be listening to the extent to which the White House has together a major plan able to address the economic fallout from this. That's certainly what the Fed is looking for, to more greatly address the Main Street issues here. The Fed is clearly focused on trying to get trade going smoothly, or markets functioning smoothly, especially in the Treasury and fixed income markets, but also bringing rates down to try to help where it can. But again, if there's very little economic activity and that is on the wane, lower rates is not going to be of tremendous help. The best the Fed can do here is to try to make markets function more smoothly. What the White House can do with the fiscal side is address more in a detailed way, in a more pinpointed way, the economic pain that individual industries and individual workers will feel.
Right. We'll be looking for those the targeted measures this afternoon. Steve, thanks. That's going to do it for us here on Squawk Alley. Let's get to the judge in the half.
Appreciate it so much, Carl. Thank you. Welcome to the Halftime Report. I'm Scott Wapner. So good to have you with us today. We're trying to make sense of all of this, just like all of you are. Our show is going to look a little bit differently in the days ahead. Our investment committee will either be on the phone or coming to us via Skype. However, we are going to try and bring you the same level of debate and discussion as we always do. Josh Brown, Joe Terranova, Steve Weiss are with us today. So are a number of special guests. Ricky Sandler of Eminence Capital, he'll join us in just a few, along with Avenue Capital's Mark Lasry. BlackRock's Bond King, Rick Reeder, is here. So is Dick Costello. He is the former Twitter CEO. You know about stocks by now. Getting crushed again as the coronavirus crisis changes the way we're all going to live for the near future, at the very least. Markets trying to make sense of all of that, how just deep this economic dislocation is going to end up being. I should let you know, as Carl said in the handoff to our program today, we are about 1,000 points off the lowest levels for the Dow today, but it is still a rough day. Josh Brown is with us via Skype. I said Joe and Steve Weiss are with us on the phone, so bear with us as we get through all of that. Josh, I go to you first. Just sort of give me your thoughts about where we are and how you're feeling about things today.
Well, so I would say that obviously stocks are well off the lows, but, you know, people are saying, is this the bottom? Was that the bottom? I'm not sure that's the right way to be thinking about the market overall, but it is encouraging to see the XLF, the bank stocks, 11% off their morning lows. I think that's 100% due to the actions that central banks around the world have taken. Forget about the overall level of rates. Dollar swaps are very, very important right now. People that are bringing collateral to the window should know that they can continue to do so for as long as they need to do so. As of this morning, I was looking at Disney and JP Morgan, Judge. I own both stocks. Each of them were 40% off their highs at those lows, recovering somewhat. The S&P 500 at its morning low was 30% down from peak to trough. The Russell 2000, 37% down. Needless to say, in a short period of time, that's a huge decline. That's a huge decline in any period of time. But in this period of time, that is absolutely historic. Transport's 38% off peak to trough, and the semis down 32% off their highs. So now if you're saying to yourself, well, do the fundamentals justify seeing all of these major averages 30% off their highs? My message to you is that markets will way overshoot whatever you think the fundamentals should dictate. So we should not be looking at things like PE ratios or next month's or the following month's same-store sale. None of those things are going to matter right now. You have this combination of two things. First, people that haven't panicked yet, now is their chance, and they're panicking even more so. And second, there are mechanical things happening in the market, like value at risk calculations, that have major pools of capital literally being forced to sell. There are strategies that react based on volatility, and they sell even more.
Right.
So I think what the Fed did, they're not going to forestall a recession, but I think they've created the conditions that will allow that forced selling to take place as it needs to, and that's a positive.
Joe, Josh lays out an interesting perspective, and that's you look at some of the stocks and these marquee names that have come down so far and come down so fast, and one side of you says, it's the realization setting in that nobody really knows where all of this is going to settle out.
I would agree with Josh's comment. Right now, it's not a matter of where is the bottom. You're not trying to find that. Right now, assets are pricing at a level that's telling you you're going to have to assume much more risk than you've had to assume in the last 10 years. And for the assumption of that risk, Scott, the expectation is that somewhere in this process, you will be rewarded for taking on more
Joe,
of that risk.
I'm gonna have you redial in. Your phone line's shaky a little bit. I just want to see if we can do a little bit better than that. Bear with us, all of you. Please bear with us today. Steve Weiss, you want to chime in on sort of what you're thinking about? You heard Josh's point. Just give us your thoughts. You've seen a lot of these markets. I know you're trying to figure things out on your own right now.
Yeah. So look, my target has been, without any firm conviction, down 30%. On the market. We've hit that down 30% from the highs, but I believe it will now be greater. To me, this is worse than 08, and I've lived through 2002, I've lived through 2000, through 98, through 87, and this is different. And the reason why it's different is that in those environments, you can say, this is the problem, this is how we attack it, and this is how we cure it. Here, and the problem was generally, if you go to 08, it was too much leverage in the system, too much leverage, primarily financial institutions, consumers, and then, of course, the auto companies and some others. Here, the issue is not that. The issue is that there's no demand out there as everybody hunkers down at home or in their office, if they can go to the office, like I'm in my office because I'm out in New Jersey, and you're not sitting there saying, here's what it's going to take for me to go back into the world of commerce. You're not. So in an economy that's 60 to 70% consumer driven, there's no cure for that except for time. So there's no monetary stimulus that's going to get me to go out and re-engage with everybody or anybody else. And fiscal stimulus at this point in what we're dealing with the virus is also unlikely to do anything. It'll give you some comfort that things may not get disastrous, but not to get you to go buy. So I think you have time. And Josh is right. Throw out fundamentals, but you should also throw out where stocks were before. So it makes no difference where JP Morgan was, where Disney was. That's a frame of reference that just doesn't matter because we don't know how long this will take. And in fact, whether we get back to that in a year, 2 years, or 3 years.
Let me
stocks
bring in
will be higher in a year but that's as far as we can go.
Right. Let me bring in another voice to the conversation now. Ricky Sandler is the CEO and CIO of Eminence Capital. He's with us today on the phone. Ricky, can you hear me?
I can hear you.
You reached out to me on Friday and wanted to come on with a message, and that message is what?
That I'm very optimistic and very bullish about stocks at these levels. I couldn't disagree more with Mr. Weiss about everything he just said. I think the people are totally missing what is happening here. Every new headline, every new hysteria is making people more nervous, and it's actually very, very positive. It's all helping to contain the problem. We are acting in a way that nobody ever thought we would. Everybody that looked and said this wasn't going to be that big of a deal, just look at China, then said, well, China, we can't do what China did because they're an authoritarian society. Yeah. Well, we just did. Okay? Everybody's self-imposed quarantine. We've gone to mass quarantine. We are actually going to contain this much better than the early fears. I can't tell you, and cases are still going to go up in the short run because that's what happens for at least a couple of weeks. But all the people that read the early stuff about what was going to happen in this country and the deaths, I believe they're going to be greatly exaggerated because of the dramatic actions that citizens have taken, that businesses have taken, that local governments have taken. Everybody has taken this seriously, and the best defense to this virus is to be on guard. So that's point number one.
Understood.
Point number two, let's talk about the economic risk to everything stopping for 2 to 3 months. U.S. GDP is $20 billion a year, $5 billion a quarter. Goldman Sachs came out and said Q2 GDP down 5. Let's assume they're wrong and it's down 10. That's $500 billion of lost GDP. We have lost $10 trillion of market cap. One-time $500 billion GDP hit, and we've lost $10 trillion of market cap. It is so far out of proportion, I don't even want to talk about the numbers. Secondly, we have government stepping in to cushion that $500 billion economic hit. This entire market would turn around in 1 second if the government came out and said, we are going to provide business interruption insurance to companies that lose money in the second quarter if they don't fire any workers. That solves the whole problem, because right now there's a negative feedback loop of, oh, you serve a restaurant, your business is going to be down. All these restaurants are going to go out of business. Everyone's going to... The truth is, A, I think the government should and will step in here to do something. B, it is not the end of the world, 1 quarter of big negative GDP. And then 3, are banks and landlords really going to foreclose on businesses because they had a 3-month drop in revenue from 30 to 90%? I think people are much smarter than that, and the real economy works very, very differently, and confidence will actually be back in this market and this economy over the next 3 months. What? In fact, go ahead. I'm sorry.
No, you finish. You please finish.
In fact, if you really want to be really bullish, what you will soon realize, I think, is that everybody can plan the second half of the year. They understand that this will be behind us. They understand business levels will be back. We will have pent-up demand. We will have massive fiscal stimulus. We will have lower interest rates and lower oil. I would argue business and the market could make new highs from that. Now, against the backdrop of that, you have tons of stocks down 50% that are really good companies. So this is an opportunity. My message to your viewers is refinance your mortgage and take the money and buy some stocks.
And you've been doing just that? You've been buying stocks?
Yes, I bought stocks on Thursday after late in the day, Friday, and today.
What kinds of stocks are you buying?
I'm going more for the beaten down stocks like a Marriott, a Live Nation, the U.S. Food Service. This company sells food, delivers food to restaurants, schools, institutions. I get the near-term drop. Its stock is down 60%. 6-0. This is one of the most stable businesses in the world. We've been buying financial stocks. I think Bank of America and J.P. Morgan, even though rates are down, their spreads are actually going to be up, and they're going to continue to earn money. So you can borrow money against your mortgage at 2.5%, 2.75%, and buy stocks that yield 3 times that level today. Forget about how cheap they are and how much they're going to go up.
What do we do, though, with the fact that what if this is longer than the 1 quarter that you say? And what happens if we sort of look at this and say, okay, it's not 08, but it's as bad, if not worse, as Weiss was saying, but in just different areas. Sure, it's not targeted on the banks, and we're not worrying about the entire financial system going to hell in a handbasket. But you have a humanitarian crisis, a health crisis, and an economic crisis all happening at the same point.
Right. So we just talked about the economic crisis, which I don't think we have. But let's talk about the other. So I think if we look at the facts, if we look at what the experience is and what really happens with this virus, I think a lot of people don't appreciate you can't get this virus twice. So if the worst case it ran through our population, and this is what the UK is doing, and we had tragic loss of lives, which would be horrible. I don't think it sets back the economic engine, and I also think that consumers realize once they got it, they couldn't get it again, so they're back out doing things. So when you look at the death rates are adjusted very low. I'm not minimizing the risks here, but I also want to talk about the facts and it, in places where they have engaged in the kinds of activities that we have now, they have dramatically slowed this. And so even your worst case, which would be more deaths, would be tragic for humanity, but would actually not be an economic tragedy for businesses.
How soon do you think we need to get plans out of Washington so that your thesis plays out the way you think it might? Because there are people who are going to be listening to this interview, Ricky, and hearing your optimism and welcoming it and wanting to feel better about a situation that feels so bad.
Yeah, no, I think it's right, and I would love to believe strongly in our political leaders to come together. The nation has come together in the last week. When you see what we as a society have done to get through this, it's impressive, and the government should do the same thing. What they need to do is ensure people, counterparties, small businesses that even though their business is going to stop for a short period of time, they're going to be okay. That is, it is not that much money to do it. It is not that hard to do it, but we need political leadership to come together. I honestly believe that this idea of business interruption insurance for businesses that do not lay off any workers begins to turn the entire thing around. Then nobody's worried about their job. No one's worried about paying the rent. No one is worried about their tenant paying the rent or their customers not coming back. And then everybody gets back to planning for the second half, which turns out to be very strong, and we're off to the races.
Let me let Weiss respond if I could, and I want to do it obviously in a constructive way. Steve, so you heard Ricky's case.
Yeah, and
what do you say to it?
Well, I obviously disagree. I mean, it's, Ricky his time frame is longer. Mine is too. I'm not a seller of much down here at all. I've sold enough. But you can't minimize this situation. Sure, stocks will be higher in a year, but from what level? So the market in 2008, let's not forget that the Fed made their move in April of 08. The market continued to trade down. TARP was approved finally in October of 08. The market traded down until March of 09. This is a big change. So the world's not ending, absolutely not. But to assume that we're not taking the first step, which is that 19 was all about multiple expansion based upon earnings growth in 2020. Not only are we not getting earnings growth in 2020, we're in a recession. At least I believe we are, and I think the facts will be that. So we got to get rid of that 32% initially. So when you close Disney, how long is it going to take for people to be comfortable coming back? So I'm not Chicken Little saying the sky is falling, but there's been a major fundamental change that we can't whistle by the graveyard and say everything's great. For me, it's not a question of the market going to zero. And I just got a phone with another large manager. It's when do we put money in? Because Ricky knows your return is judged when you buy. And the government cannot afford to bail out every business, every small business. And at the end of the day, we're capitalists. Sure, some landlords will say, you know what, don't worry about the rent. I've heard that before from some friends. But they'll also say, you know what, I've got a solvent tenant who's coming in here who's not going to stop it. And that's what's going to change. So, look, world's not coming to an end, but it's not cured yet at all. And I'm going with the experts who say this is not going to be just a couple of weeks. This is not going to be a month.
Ricky,
you have no choice to do that.
I'll give you, Ricky, the last word.
Yeah, this is not 2008. There were no systemic problems in the system. Banks are lending. Money is available. You had a lot of action, reaction. Then when people freaked out, they removed counterparties and they made the system worse. Today, when people freak out, they're staying home and they're solving the problem. It is very, very different. The market is a discounting mechanism, so I disagree. Like, I don't know when the market bottoms. I obviously started buying on Thursday afternoon and Friday, and today I look wrong. But in 3 months, in a year, Mr. Weiss even said in a year, sure, stocks will be higher. Sure, people are going to go back to Disney World. I mean, what signal do people need to actually come back in and buy? Stocks like Disney are down 50%. Like, this isn't a small change in like the market value. This is the largest in mass decline in stocks except 08, and frankly, the economic impact of what is happening is much more contained. And when people begin to realize that, yes, some small businesses may go out of business. I'm not going to disagree with that. But if the government steps in, and even if they don't, businesses will step in. The economic impact is one sharp quarter of hit.
The only thing I would say, Ricky, look, your points may bear out, but I don't know, at least on the point of not being able to get this thing twice, that there's any scientific evidence that you can't. And there have been reports of those in other countries who have gotten it twice. I just want to be a little careful what we're putting out over the airwaves at a time when people are scared as hell and worried about themselves and their families. So, I mean,
all the data suggests people are not supposed to get this twice. Could someone have tested positive twice somewhere else? Sure. This is not necessarily something that you recurring get, and if it were to happen, it would come back much more mild. So again, I'm just trying to talk about kind of basically what the factual perspective is about this virus, and also try not to have people feel like this will be with us forever.
I understand. I understand. I mean, it's just, I just wanted to be clear with our viewers. You're speaking with a lot of certainty about a lot of different things, and you're certainly entitled to do that. It just, at least when it comes to the science and the health part of this whole thing, I just wanted to put that out there, that we just honestly don't know. We just don't know.
I respect that.
Okay. Ricky, I appreciate your point of view today. I know our viewers do as well. Thank you so much for calling in.
Okay.
All right.
Thanks.
That's Ricky Sandler from Eminence Capital today. Let's bring in Avenue Capital CEO Mark Lazary. He joins us on the phone now. Mark, you there?
Yep, I'm right here.
You heard the whole conversation with Ricky, I hope, or at least most of it.
I did.
Watching the market here. What are your thoughts?
I actually think both Ricky and Stephen are right. If you think about what's going on, the market is definitely going to be higher at the end of the year. The question is, how much lower does it go from today before it starts moving back up? And so where I think Steve is correct is, I think the news that's going to come out is still going to be negative. So it may not be negative, where companies are going to have lower earnings, or you're going to have things like that. But really what you're going to have is all the news that's going to come out about more people having it, hospitals being overwhelmed. If you sort of think about what happened in Italy, we'll have the same thing. Hopefully it's not as bad. But I think the market, even though the market knows that's going to happen, you're gonna find things will end up being lower. Where I agree with Ricky, I think it is a massive buying opportunity. I think you're never going to be able to time this thing. And if you've got the luxury of time, so if you know that you don't have to sell next week, then I would absolutely be a buyer. And, should you start coming in today? Absolutely. Should you come in at the end, at the end of the week? Yes.
I think every time there's a down move, you should be buying. I think for us, we're going to start. We haven't bought that much in the last week, but you're going to see us investing a lot of our capital over the next 30 days. And the reason for that is I don't think we can time it. I think we've been pretty lucky so far in that we haven't put a lot of capital to work because I thought things would get a little bit worse before they got better. But I think with what the Fed is doing, fixing all the, making sure there's liquidity there, that's really beneficial. So now what you're talking about is how long is this going to last? Whether it lasts 30 days, 60, 90 days, when it stops, things will start coming back. So I think you'll see us investing over the next couple of weeks.
Wow, that's interesting to hear. Will you be investing, Mark, in an area that people don't generally think of you as being a huge player in, being equities?
I don't think we'll be doing equities. I think you heard that the same issues you've had on the equity side you have on the bond side. So bonds have dropped, very, very low. You got prices anywhere between 40 to 75 cents. In some situations we bought some debt, can't talk about it, but we bought some debt today around 25 cents in a situation where, a few months ago it was double, triple that amount. So I think for us, you're starting to see that. You're seeing in a lot of different industries. So we are starting to come in, and I think for us and our investors, it's going to be a pretty unique time. It'll be, and I think, 6 months, a year from now, you're going to see people who've invested just like they did in 08 and early 09, that they're going to do exceptionally well.
What do you think the end result is going to be from the government and from the Fed? I'm assuming you think the Fed's not done. We had that second and, unique repo operation a little bit earlier today, the big move Sunday night. What's left?
I think the Fed's going to do whatever they can. I think where Ricky's right is this isn't a financial crisis. What you really do have is you've got a bit of an economic crisis. And what I mean by that is people are staying home. People aren't spending money. You're seeing that airlines are, closing down, I think, 75% of their flights. So I think that when you look at that, how long is that going to last? I don't know. But I think the Fed is going to do whatever they need. It would be nice if the federal government would step in and provide a little bit more leadership. I think what you've got is the leadership that's going on today is really being done at the state levels, and it's states that are doing that. And I think we're getting to the same place, and I think that's fine. But, would I love there to be business interruption insurance? Sure. I'd love that. I think everybody would. Mm-hmm. Do I think that'll happen? I agree with Steve. I mean, I think it's exceptionally hard. I think we're going to try to help people who will have the most issues, but for most businesses, it's going to be kind of hard to get that.
Do you feel better today about the credit market than maybe you did when you were on with us? I don't know if it was even a week ago at this point. These days all blur together.
Yeah, they do. I think there's more opportunity. I'm happy to see what the Fed has done. It doesn't really impact whether I'm going to go out and buy. To me, people aren't looking at the Fed. People who look at the Fed are you and I. And really all I care about is that the system is working, which it is. But, for us right now, as I see prices just continuing to drop, I think that for what we want to do, I think that's a huge opportunity, and we'll start taking advantage of that.
Last question before I let you go, and I'll just steer it just for the NBA for the reasons that you are the owner of the Milwaukee Bucks. Do you foresee the league having a season at some point this year?
I think so. I think we will. I just don't know how many games. The question is, where are we 30 days from now? And I think we'll all reassess. If things end up, if it looks like the worst is over and we're coming out of it, then maybe we end up saying, look, we'll keep postponing for another 2 weeks. I just don't know where we are, and it's hard to make any of these assessments. So I think what everybody's going to do is what's in the best safety of everybody. But ultimately, at the end of the day, if things are still bad 6-8 weeks from now, there's no way you've got a season. I think because of the fact you've got almost every business is literally self-quarantining. Right now, we're doing the same thing. We've closed our office for the next week. We'll probably do it for about 2 weeks. All our offices throughout the world right now, everybody's working around the house, is working at home. So I think if more, and at least from what I see, more and more people are doing that. So it looks like this is going to be shorter as opposed to longer, but who knows?
We'll make that the last word. I so much appreciate hearing your voice on our show today, Mark. Thanks so much.
My pleasure. Thank you for having me.
Yep, that's
Take
Mark.
care.
That's Mark Lasry. All right, Joe. Joe Terranova's back with us. Hopefully his phone line is sounding a little bit better than it was about 20 minutes ago. Joe, you there?
I am, Scott. I apologize for that. Amazing in a world where a landline doesn't actually work.
Yeah.
But,
so
anyway,
I want to ask you this.
Yeah.
I want to ask your reaction to. So Ricky Sandler and Mark Lasry are who they are because they've made good decisions more often than they've made bad ones, obviously, right?
Correct.
Both of them were much more positive than not on the market in various places, stocks and fixed income. Different opportunities in credit, different opportunities in equity. Is their optimism misplaced today, or do we need to take more stock as it is of what they had to say?
I think there should be optimism, but I think there needs to be a degree of realism. And I think a lot of what Steven said is correct. You have to understand that Wednesday evening, the world changed basically when Adam Silver decided to suspend the NBA season. And we, the next day, did the show, Scott, with the S&P basically where it is right now. If you're going to sell the S&P and the Dow Jones, let's say in the instance of the Dow Jones, you're going to go down 2,000 points in a day, I'm a buyer. I'm always going to buy the Dow Jones down 2,000 points because of the optimism that a year from now stocks are going to be higher. So I think you have to just accept that this is going to be a process. I began to say before, you have to realize you're not looking for the bottom, as I heard Josh say at the top of the show. You have to realize that you are assuming far more risk in this environment. That's exactly what credit and equity assets are pricing. If you are going to be an investor, you're assuming more risk. But on the other side of that, for the assumption of more risk, you're going to see more reward. So I think this is the process, and I think you have to be realistic and just understand and accept it as an investor that, yes, if you're going to mark things down significantly in the course of one day, I'm a buyer. Scott, I was a buyer when it was down 2,000. I bought this morning on the open, and I'll buy again if you're going to mark if you're going to take the market down 5 to 10%. But I'm realistic, like Steven said, to understand we're not hitting the restart button on the economy that quickly because I think you have to be very judicious about when you want to do that. Even when the numbers in this healthcare crisis look like they're beginning to peak in the United States, I don't know that the return to economic activity should be a stampede. It has to be a very slow process over time, and I think we have to be realistic and understand that.
What'd you buy, Joe?
So I've been adding to existing positions that I've had. DocuSign is higher today, so let me by no means come on the air and say, hey, I'm a genius on DocuSign. I did reinitiate in JP Morgan, which I had taken off before. I bought more Apple. I bought more Amazon. I bought more Goldman Sachs. These are the type of names, quality businesses that I believe in. I bought more Adobe as well as I scanned through my sheets. I'm adding, and I'm going to continue to add. And thank heavens I had a little bit of capital from selling out towards the end of January and February when yields came down that I did that. I will also tell you, and you know Dave Albright and Newfleet very well, I'm talking very actively with Dave about opportunity in the credit markets because I think that's where the first opportunity is going to be because, Scott, what the Federal Reserve did last night is exactly what the credit markets and investors wanted. They went in and made sure that the credit markets are operating and functioning smoothly, and they are today.
Right. Joe, thank you for that. You stay with me as well. Let me go to Eamon Javers now, who has breaking news for us on the lines. Eamon, what do you have for us?
Yeah, Scott, I've got a bunch of items for you here. Larry Kudlow just finished gaggling with reporters in the White House driveway. He said a couple of important things. One is that the administration's total fiscal stimulus package, he says, will be about $800 billion. About half of that, he says, is the payroll tax cut proposal the president has. Now, that doesn't have a lot of support on Capitol Hill, so bear that in mind. He also said that on the airlines, he was asked if the airlines have been in touch with the administration asking for assistance. Yes. He said they've been in touch with the airlines in terms of cash flow, so stand by of that conversation. He also threw out a proposal for 100% deductions for companies bringing their supply chains back to the United States from China. That's something we heard, sort of a similar theme from Peter Navarro this morning. That's an idea Kudlow says is kicking around the White House as well to guarantee that there's more manufacturing capability here in the United States. A couple of other news items to bring you up to speed on as well, including a cyber attack now today on HHS. According to a U.S. official, we are aware of a cyber incident related to the Health and Human Services Network, and the federal government is investigating this incident thoroughly. They say HHS and federal networks are functioning normally at this time. Separately, U.S. officials say there is a disinformation campaign underway right now online, so bear that in mind. A senior administration official telling me there's an ongoing effort to spread disinformation and cause undue panic. There's no national quarantine for the United States. It's important we remain vigilant in ensuring our information is coming from verified sources. So beware of a disinformation campaign that is ongoing now online. And finally, I can tell you that I've been talking to officials here. Our Meg Terrell's also been making calls and talking to folks familiar with what the coronavirus task force is thinking right now. They have two scenarios for the peak of this coronavirus at this point. One is, the most optimistic scenario is that this will peak a month from March 14th, that is this past Saturday. So 1 month from now would be the peak. That is the optimistic scenario. The pessimistic scenario, I am told, is that the peak is 3 months from this past Saturday. So 3 months out, that's a much longer time horizon, but that's sort of the range of the thinking right now inside the federal government of where this thing is headed, Scott.
I'd like to believe the most optimistic at this point. I think we all would. Eamon, one more thing before I let you go. Has there been any reaction at the White House to this Romney float of sending $1,000 per adult to every adult in America?
I have not heard that. They've been skeptical in the past of what Kudlow has called helicopter money and the idea of just blasting money out to everybody. But, you know, every day is an entirely different sort of political environment and news cycle. So things could be changing quickly. We'll reach out to some folks and see what they say on that one.
Appreciate that. Eamon, thanks so much. We'll come back to you as needed as well. Rick Reeder is the CIO of Global Fixed Income at BlackRock, where he oversees more than $2 trillion in assets. He joins us now on the phone. Our East Coast bond king, as it were. Rick, it's good to hear your voice today. Thank you for being here.
Thanks for having me, Scott. So, I'd rather be there actually than at home. But,
I wish you were here. I wish you were here as well. But these are the new times that we're living in. So we'll just deal with what we have to do. Just give me your thoughts. We've had extraordinary action from the Fed over the weekend. We had a second repo operation today. Just talk to our viewers. What are you thinking?
So, I mean, listen, when you take what the Federal Reserve did, I think I called it last week awe-inspiring before I saw what they did yesterday or last night. And quite frankly, before what they did again today. I mean, the Fed is working, I got to believe, 24/7. They are, I mean, the things they're doing are bold. They're, we said it before that what was done in the financial crisis was innovative. You got to do that. You got to be creative, and they're throwing not only a lot of artillery at this, but it's durable. It's getting at the right places. I mean, the big one we got to get at is commercial paper. That is one that is hugely important for the markets, hugely important for the banking system. And my sense is, there's a series of hoops they've got to jump through to make that work, and they're on it. So anyway, I think what the Fed's doing is impressive. When you go through what you just described, or even just described around the virus peaking a month to 3 months from now, you take what normally what the Fed is doing, this would be the most epic rally we've ever seen. The problem is, gosh, when do you take the risk if there's such great uncertainty around that date?
And look, people are trying to game that out. You heard some of the folks who were on our show prior to you who suggest that now's the time to do it, that you're not necessarily going to be able to time the bottom, but that's their own opinion. I do want to read you a tweet today from Mohammed El Arian, and I'd like your response to it. It speaks directly to what the Fed has done, and in some cases, what he says they haven't done. And then you can react on the other side. Am baffled and upset with what the Fed announcement, as well as what it didn't announce. Baffled because measures more targeted at actual and potential market failures are more effective at this stage. Upset because of the damage that's being done to U.S. and global economic well-being. How do you respond to that?
So Mohammed's pretty thoughtful about perspectives on the economy and the Fed and monetary policy generally. Listen, I think it's very hard. I think when you're sitting in those seats and you try and determine how do you get at what is the most critical point in stress in the system, it's really hard, particularly when you don't have all the tools. For example, talking about commercial paper, they've got to go and get some evolution around 13.3 and work with Treasury. It's hard, when you think about what they've thrown at this and the time frame that they've thrown at it, i.e., they'll keep going. Listen, I think they're doing a lot of good things, and I think what they said yesterday, negative interest rates are not appropriate, but forward guidance and asset purchases are, and boy, they're doing that pretty aggressively. And I applaud them for that. And they're working on the other things, which just take a bit of time.
I was going to ask you about this idea of negative rates. I know that Powell doesn't want to do it. I think most observers and reporters have suggested that he doesn't want to go there. But is his hand going to be forced at some point?
I don't really think so. I mean, when you take rate to the zero bound, I always talk about this a lot. When you're in an aging demographic and you actually do more damage than good, because how it hurts insurance companies and pension funds and individuals. Asset purchases get at liquidity, get at the currency. It's much more efficient. So I don't think that is in their toolkit, and I don't think we'll see it anytime soon.
The op-ed today in the Journal by Kevin Warsh, let the Fed administer an antiviral shot. An emergency lending program would keep a liquidity crisis from turning into a solvency crisis. Your reaction to his comment?
I think that's right. You've got supply chain breakage, you've got cash drains around the system. The idea of that gets to that point about targeted initiatives that get at lending, get at cash drains across the system. That's a sort of innovation they've got to do, and I think that's really powerful. I'm going to make one comment about what you were saying earlier. We're seeing valuations in some companies that are cash-rich or free cash flow generative. They're going to have a tough month or two. When you put in place some of those initiatives, like a lending program, those companies, you got to put them away. You got to do it in small size, given the uncertainty of the markets. And you got to think about, gosh, I'm not going to hedge them, because you look at the price action in gold, you look at where treasuries are today. I just want to own those companies organically, particularly if it's willing to do some things like described.
You think, obviously you're the CIO and head of global fixed income, but you think some stocks are too attractive to pass up even today?
I do. I think you got to be deliberate in how you do it. I think using some of the volatility markets, depending on where you can, is also interesting. But gosh, we're looking at companies that are good growers in technology, healthcare, building, construction, that are the multiple you're paying to cash flow, and you've got to haircut it for the next couple of months aggressively. But even when you do that, we put down numbers where you shock some of these companies down so aggressively, gets a significant negative free cash flow over 2-3 months. You're still trading at multiples that are incredibly attractive if you assume some sustainable growth rate over the next 5 to 10 years. So anyway, you're supposed to do that. And again, you're supposed to own them organically and not worry about how do I hedge them with my portfolio. Just I'm owning them because I'm long cash in my position and they're good assets, don't.
Rick, we'll leave it there. Appreciate you coming to the phone today for us, too, helping us understand all of this. That's Rick Reeder, again, from BlackRock. Josh Brown, haven't heard from you for a while, and you've heard from a number of real smart investors running an awful lot of money. What are your thoughts on what you've just heard today?
Well, so I talk to financial advisors all over the country, advisors probably combined managing over $100 billion. And one of the things that strikes me as being very encouraging is that for every call advisors are taking from clients about, is this the time to get out before it gets worse, they're getting another call, people that said, you know what, I actually want more stocks, let's take down the bond position. People that have treasuries have seen gains in those positions, and they're saying, I get it's not the bottom, but I just feel like if I don't do anything here, if the market sells off 25% and I don't react, I'm going to regret it. So you could look at that two ways. You could say, these people haven't had enough pain yet, they're complacent. Or you could say, you know what, these people have learned the lesson of the last 20 years, which is that terrible things happen from time to time, but things get better. I want to point out some research from my colleague Michael Batnick about what happens after the stock market declines 25% from its high. That has actually only happened, Scott, 7 times since 1950. Here's the bad news. Over the next 1 year period, basically you could flip a coin. The outcomes are all over the map. But something very interesting happens on an average annual basis after that first year, which is 9.5% gains. And that goes out for 1 year, 3 years, 10 years, 20 years, 9.6% average annual returns if you bought the first day the market dropped 25%. So this isn't a bottom call. This is just a realization that the people who have stepped in and said, you know what, I get that it could get worse. I don't care. I'm an investor for the long term. Those people historically, 7 times since 1950, have been rewarded. So that's the way financial advisors are thinking. And fortunately, many of their high net worth clients are thinking the same way. And that's very, very optimistic and positive.
Weiss, I mean, that's how Lasry, Sandler, and Reeder are. Oh, well, we lost Weiss. But, Joe, that's how those guys are thinking. Lasry, Ricky Sandler, and Rick Reeder. You just heard it straight from them.
Yeah, they're assuming risk, and they're understanding what that assumption of risk is Josh is actually pointing out. It may full for the assets that they've purchased recently, and they're not going to know where the bottom, but ultimately they feel as though they're going to be rewarded. Scott, again, this is a process. There's much more work that needs to be done. We haven't even begun to tackle the oil issue. Oil's below $30. We need to address that. The Russians, Saudi Arabia, and even the Americans need to collectively get together and see if there's something that they could do in terms of taking supply off the market. That's a problem. So the fiscal response is needed. The healthcare crisis is needed. And individually as a country, the concept of social distancing, how seriously are we taking that as citizens? That's important. It's a mosaic of things that need to occur. It's a process over time. I'm optimistic they're going to happen, consistent with what Mark Lasry, Ricky Sandler, and Josh are saying.
We'll add our 4th special guest of the hour today, Dick Costolo. He's the former CEO at Twitter. He is currently managing partner at 01 Advisors. He joins us on the phone. Dick, welcome to the program again. It's good to talk to you today.
Yeah, great to talk to you too, Scott.
Give us how you're thinking about the markets. You can speak through a tech prism or just as a broad investor and a big thinker. What do you think about where we are?
Well, I sort of agree with what your most recent folks on the show have talked about. It's historically, this is a great time to make sure you're thinking for the long term. I've been buying, just slowly buying on a day-to-day basis, not worrying too much about whether we're going down further or whether we're going up big. We'll get through this. The world will get through it. It's going to be rough sledding here for a while, but trying to predict when, as everyone has said, trying to predict the bottom or trying to wait for things to fall out of the bottom is just a silly way to go about it. So at the end of the year, the people who have put money to work now will be happy about it. That's the way I think about it.
Can you give us an idea of how the tech community is thinking about all of this and what broad impacts there may be out in the Valley?
Yeah, it's a great question. I think there are sort of 2 sides of it. On one side, there's sort of a growing chorus of folks who feel like, look, the social contract between, the country and our business leaders is the country gives us space to innovate the way we want to innovate, to pursue our dreams, to make and keep a fortune in many cases. And on the other side, we're expected to create opportunity, create jobs, and be real leaders, and step up to the microphone in good times and in bad. And I'm sort of surprised. There's a growing segment of folks out here who feel this way. Sort of surprised we haven't heard from more of the business leaders and executives. For example, it would be helpful to hear from the Costco folks, the Amazon folks, the Walmart folks about the supply chain. And there's been a comment here or there, but not a lot. And I think a lot of people in the country would like to be reassured about supply chains and that the products and goods are going to be there when we need them in the next few weeks. And then similarly on the tech front, it'd be helpful to hear more from the Googles of the world about what they're doing beyond just the things that have been announced in random presidential press conferences that prove to be partially true, and what they're gonna try to do about it. So I agree with those folks. I'd like to hear more from our leaders on all those points.
What responsibility do you think our social media creators and or CEOs, because the founders by and large are the CEOs of those companies, have at a time like this with spreading a needed message of any kind? The government is trying to tell people you need to socially distance and you need to do it now. To what degree does Dorsey need to get out on Twitter and Zuckerberg on Facebook and Spiegel on Snap? To what degree they even can and help in spreading that message? Because I haven't seen it, and I admittedly might have missed it, but I don't think I did.
Yeah, I think that, again, generally to my point, I think all of these tech leaders, it'd be helpful if they stepped up and were talking to the country more about the things on the platforms that are misinformation that they're helping eradicate. You know, the Zoom CEO did a great job of stepping up in America and providing, his platform for free for some period of time to the U.S. education system right now. It'd be helpful to hear from more leaders across the board on all this stuff. So, I'm in short agreeing with what you just said.
Yeah. Dick, I know you're busy, and I know you had a lot going on today, but made some time for us. We appreciate it. I'll talk to you soon.
Happy to do it, Scott. So long.
That's Dick Costello for us. Josh, you want to react to that as well? I mean, you're as big of a player in the social media landscape as we certainly have on our program, and maybe in this building, you and Kramer.
Yeah, well, so I appreciate that. I think that YouTube, in particular, has been doing a lot of the right things in terms of deliberately removing things that are misleading or conspiratorial. And I do think that in general, social media is what separates this from prior crises. And the example I want to give you is, can you imagine an episode like this prior to us being able to work from home and communicate with each other on Facebook, on LinkedIn, to verify that our friends are okay? This was not always an option. It would have required 100 phone calls a day to be in touch with as many people as the average American is now in touch with. Now, here's the negative side of that. Social media is beaming images to us of overrun hospitals in Italy. And that's probably something that we would not have had to psychologically deal with in prior crises. So I think we're very adaptable in modern society. I think as much of the negative side of Twitter and Facebook, and I could go down the list of all the things
central banks can throw kitchen sinks or not. But at the end of the day, the fact that businesses aren't going to be getting revenues, they're not going to be sending out bills, that's what's going on. You can talk about confidence, but the central banks can't address how many cases, the numerator and denominator, mortality rate, all the things the market needs to get its arms around on the coronavirus to truly do better pricing. Look at a 2-day of 2s, look at a 2-day of 10s. You know, we're getting back into the previous session's ranges from Friday, but Kelly's right. What the central bank did was, in a way, pull the rug out. Yes, it's easing, and it's going to make the gears potentially turn better, but it really does throw a GPS monkey wrench into it. And if you look at what's going on with the yield curve, you know, we had many guests today say, yeah, maybe the yield curve doesn't matter. It does matter. This complexion of the curve gives you a very good idea if there are short-term funding glitches. And finally, the dollar index. Maybe it's not going to have its 5th up day in a row, but in this instance, that might be a good thing. Let's make sure all the rest of the world that's having a really rotten couple of trading sessions is able to get their hands on as many dollars as they need to. Think emerging markets here. Kelly, back to you.
Rick, I don't want to catch you flat-footed because I know you're not on the floor of the CME right now, but I want to ask you about inflation expectations. You know, if you wanted a benchmark for if the Fed's moves are quote-unquote working, you'd think they'd be increasing inflation expectations as a sign that the economy is going to start to get back to normal and back on track. And the opposite has been happening today, hasn't it?
Well, I'll tell you what, in my opinion, I think you're going to see more deflationary pressures right now. But there is little doubt when the markets, when doctors, when we all get our arms better around the coronavirus dates, mortality rates, you know, different hot zones, once that occurs, my guess is that you're going to see demand shoot up, and that demand is going to be the type of demand where, hey, I don't care if I have to pay overnight, I don't care how you get it here, I want it here tomorrow.
Right.
I think we do get a spike on the back end of this on the inflation side.
It makes it doubly dangerous. Mike Darda was making that exact same point today. All right, Rick, thanks for now. We appreciate it. Sir Rick Santelli out in Chicago. The market is responding. Well, let's ask, is the market responding so poorly today because the Fed didn't do enough with its emergency moves yesterday, or because it's not the right kind of help? Joining me now to discuss that, Bryce Doty is Senior Portfolio Manager at SIT Investment Associates. Neil Hennessy is Chief Investment Officer and Portfolio Manager at Hennessy Funds. And Daniel Ahn is Chief U.S. Economist at BNP Paribas. So it's great to have you guys all here. Daniel, you're the economist. Let me begin with you. Do you think that the Fed's moves will have an impact, at least on the economy in the longer run?
It certainly will have an impact on the economy. I think Chair Powell said it perfectly when he said, look, monetary policy, it can't cure a virus, it can't fix a broken supply chain, but it can provide support to business and household sentiment, and it can continue to keep financial conditions accommodative. So, yes, I don't think it's a sufficient condition to support the economy out of this likely pending recession, but it is a necessary condition and will probably make it not as bad as it might have been.
Okay, and Bryce, you know, people have made the point that that might be true, you know, say in the next couple of months, a month from now, 2 months from now, 6 months from now, but for right now, businesses face a cash crunch. So on that count, is the Fed doing enough to help here, or is it really the government that needs to step up with more?
Yeah, I think it's really...
Well, I think the Fed did need to...
Bryce Doty, go ahead.
Okay, thanks. I think the Fed was right to hit the panic button and flood the markets with cash, because there is a massive need for cash on all levels, both individuals taking money out, running the bank types of cash, but a bigger problem in bonds is liquidity. There's very few bonds even trading right now. Even money market type bonds are trading poorly, if at all. So they need to address that liquidity in the biggest way possible, which they're trying to do. But again, you're correct, it doesn't really solve the underlying problem of the virus, and people can't well, if you know, we have school break for 3 months in the summer. Let's take one of those months and do it right now. Close all the businesses right now, you know, rip the Band-Aid off, take the pain, the economic pain right now to save, you know, bankruptcies and job losses and deaths down the road. And if we did that, the stock market could at least try to quantify what the hit to earnings is going to be. Right now, it's so vague. You don't know if this thing is going to stretch on for 6 months or 2 months. Yeah, and so that's why we see this intense volatility.
Sure.
Until we get serious about dramatically slowing the spread of the virus, you won't find a bottom in stocks.
You know, Neil, the problem with doing that, with saying, okay, we're going to take all of the economic pain right now, is that it will put some companies out of business. I mean, it will push workers to the brink. So you want that reassurance that there's going to be some kind of backstop. I don't know the best way of channeling that, especially to the point Bryce was making about there being no clarity on earnings and so forth. What are your thoughts both on the right medicine for the economy here and how to invest?
Well, I think, first of all, we have to remove emotion, Kelly. I've always said if emotion enters a conversation, at some point in time, it's going to get ugly, and I've been there more than most people. And the same with the financial decisions. You look at what the Feds did yesterday. I mean, it's sort of like, why involve emotion? We are going to have casualties, especially in the small business arena, where they don't have the cash flow, the bars, the restaurants, small businesses. We have to somehow try and figure out what we can do there, but there are going to be casualties. But as you notice all day long, all these companies that are shutting down are saying, well, we're going to pay our workers. We're going to keep trying to keep them on the books. This is a situation
Reserve and Treasury work with America's banks to create a loan and loan guarantee credit facility that would be available to every employer with 500 or more employees. So the small business loans would be available for those with less than 500 employees. This credit facility that would be established similar to what we did in 2001 and 2008 would be available for the larger employers.
Okay, so again, working with the Fed. Now, does Congress have to act on this, Neil, in order for these programs to get up and running?
They do. Restrictions.
Hoping you wouldn't have to say that. Yeah.
I know. Yeah, the restrictions that they put in place in 2010 make it more difficult for the Federal Reserve to create that credit facility. They need to loosen the rules on the SBA program, and obviously we need Congress to cancel the collection of those payroll taxes so that employers have it to keep paying their employees.
Okay, Neil, thanks. We'll continue to follow this story. Neil Bradley is EVP of the Chamber of Commerce. Thank you, sir. Coming up, we'll take another quick short break. Netflix down, it was 3%, now it's 7% in this session today. We're going to talk about how it's held up relatively better amidst the downturn so far, but it might not last. We're going to explain why next. And here's a look at the markets more broadly today. The Dow drifting lower. It's down 2,100 points. That's a 9% decline for the blue chips and for the NASDAQ. Just about that amount for the S&P 500, down 242 under 2,500. We'll be right back.
It's taken 22 months to get a phase one agreement.
No one expected it to be so prolonged.
Reducing the geopolitical uncertainty around these two trade deals will have a positive impact on people's perspective.
Phase one removes a lot of overhang for the economy.
We were basically escalating to a very bad place between the two countries.
The leaders in China and the US have the wisdom to settle the differences.
Is trade winds abating, or is there still a threat?
Our customers, they did suffer with the trade wars.
There is now truth and a pathway to peace.
Words like peace, trade, war, things like that, those to me are not the right words. It's not a Berlin Wall at all. We want other people to take down the Berlin Walls.
This is a ceasefire. Hold on to your seats, because this isn't going to be solved in one mini trade deal.
The best thing that happened is we have two countries that like each other again, because it was getting pretty nasty.
Looking very closely at the impact from coronavirus on all businesses, and of course you've got this double whammy of what's going on with the headline oil price at the moment.
We've got a demand side shock, and then of course we also have the combined issue of a significant amount of oil now coming on the market in April, so that can only lead, really, the direction for the oil price can only go in one direction, that's down. We're very confident we'll come through the other end of this, and we have all the firepower within the company to be able to do it and manage that.
Hey, come on, Griff, take it easy.
What'd you say to me? I didn't do your homework, okay? I'm not scared of you.
Welcome back. Some breaking news on coronavirus. Canadian Prime Minister Justin Trudeau is right now updating Canadians on the measure his cabinet is taking to combat the impact of coronavirus. Get this, he just announced Canada will be closing all borders to non-citizens and non-residents. There will be some exceptions to this ban, including for some U.S. citizens, but a drastic move taken by our neighbors to the north, who in some cases have been criticized for not doing more quickly here. And again, a reaction to the reality of how quickly coronavirus is spreading in this country, too. Canada closing its borders to non-citizens. We'll have more for you as we get it. In the meantime, Netflix has performed far better than the market year to date. The S&P 500 down over 20%. Netflix only down about 3%, but it might not all be roses, and it might not be as coronavirus proof as you think. Julia Borston has more for us. Julia.
Kelly, that's right. Home may be streaming a lot more Netflix, but that doesn't mean that the stock is necessarily coronavirus proof. Needham's Laura Martin saying coronavirus is a negative for Netflix because the streamer does not benefit from to its flat free subscription and due to its lack of advertising. She says Netflix's international growth is at risk because of rising unemployment, and she notes that Netflix has a junk bond rating and negative free cash flow. Now on the upside, Netflix's most popular $13 a month plan may seem more worthwhile if people are spending hours streaming it at home. But on the downside, Netflix is about to face 3 new rivals, which will offer free trials. Quibi is set to launch April 6th, HBO Max launches in May, and then Peacock will roll out nationwide on July 15th. Now, HBO Max is the only one of those services that will cost more than Netflix, but it will be free for current HBO subscribers. Kelly, back over to you.
Yeah, I saw Disney. What are they doing? Frozen 2, Julia? I mean, there's some effort out there to say, hey, you know, we understand you guys are stuck at home. Only have one negative quarter, the second quarter, that's 3 months. Is there any way the U.S. can get out of this with only, let's say, a 3-month downturn, or does that not count because then that's technically not a recession?
Yes, so that's exactly right, Kelly. I mean, what the risks are rising, of course, that we will have a recession that will last 2 quarters here, which is the technical definition of a recession. But what's really unique about this is that normally a recession comes around because there's some imbalance in the economy. For example, in 2006, there was an imbalance in the housing market. In 2000, there was an imbalance in the IT sector. In 1990, there was an imbalance in commercial real estate. So that imbalance needs to be worked off, and that's why it takes time to get through this. We really didn't have any imbalance that triggered this. This literally came out of the blue. So that's why this could be turned on as quickly as it was turned off. So that's why we are relatively optimistic that this will be deep but short, because simply there is not the same type of endogenous or homegrown reason why we're seeing this slowdown.
You know, I wonder too, Torsten, like you said, a lot of times we talk about recessions as needing a certain duration, usually about 6 months. If this is sharp enough, do you think they'd count it if it were less than that, or if it was 1 quarter, maybe a rebound another quarter? I mean, there's a lot. And again, I'm not trying to get hung up on what the definition of this is. No matter if it's a recession or not, it's a terrible event for people. It's just we're trying to understand how this might play out because we really haven't been through something like this in recent history.
Absolutely, Katie. I mean, what you just spoke about in terms of stores closing, I mean, literally, this is 100% decline in sales and 100% decline in around the economy, consumption in capex. I mean, that's a very serious event relative to any of the more gradual adjustments that you've seen historically. So, absolutely, we really don't have any precedent as such for figuring out, other than trying to go back and look at history of how long time this normally takes when you have a normal recession relative to this very, very unusual situation that we're in at the moment. But good news is that, of course, policymakers, including, of course, the Fed, but also fiscal policy, are doing everything in their power to try to flatten out not only the curve in terms of infections, but also the curves in terms of limiting the recession.
Torsten, what do you think is the single most important data point for markets at this point?
I really think that there are two things that are absolutely critical to look at. We need to flatten the curve, or we need to see a flattening of the curve of new infections. There's a lot of issues going into testing, but also the flatten the curve in terms of deaths. Obviously, it's very unfortunate that we're seeing this situation where in some countries it's still going up. So the number one thing that we're watching is we need to see the second derivative in terms of new infections to start to get better. And unfortunately, as you know, in Italy and elsewhere, the lockdown, we really haven't quite seen yet that second derivative improve. That's why markets are so much on edge. And the second thing we're watching is really the policy response. We need to figure out, not only from the Fed, but also fiscal policy across countries, what is the right design? What is the right way to limit the negative impact on the economy? Exactly as you were just debating in the previous segment, there are various ways to do this, but this is the absolutely critical point that we need to see a very, very strong pushback on the negative consequences on the economy.
Okay, Torsten, thanks. We appreciate it today.
My pleasure.
Flock of Deutsche Bank. As we mentioned, the markets today are off their lows, but we're still sinking more than 2,000 points for the Dow. The regional banks, the banks in general, among those hardest hit today. Here's Valley National, down nearly 12%. We're going to talk to the CEO about this straight ahead. Don't go anywhere. CNBC's breaking news and special coverage continues on the other side of this break.
I was racing mountain bikes in the UK, and I wanted to continue to compete when I came to Dubai.
I grew up in Minnesota, and I've been in Dubai for 14 years, and I really thought it was all desert. Now I wake up and I think, which mountain should I go to today?
It's not just beaches, hotels, and deserts.
I can kayak, bike, go skiing, go to the desert. It's all here.
A lot of these activities were initially community-led, and now are strengthening the quality of life that Dubai can give.
They said it will never work. We still hear it all the time. But we built it anyway, client by client, market by market, for bonds, derivatives, money markets, ETFs, and equities, into a global electronic trading network that connects every part of the financial community. That's second to none. It will never work? Well, now it does.
Welcome to ETX Capital, a trading platform built on experience and trust. For over 50 years, we've given our customers stability and personalized services. London-based, we have a UK focus combined with a global approach. Ours is a personal, tailor-made service. Stay on top of the markets with ETX Capital, the award-winning personal trading platform.
Weekdays, Kelly Evans connects investors to newsmakers, stirs up high-stakes debates, and digs behind the numbers. Strengthen your investing strategy on The Exchange. Weekdays on CNBC.
Live from the NASDAQ Access. People talk about the presidency.
What's the economy look like from where you sit?
Influence. Squawk Box on CNBC.
Good afternoon, everyone. Kelly will join us in just a moment. I'm Tyler Mathisen. Welcome to Power Lunch. We continue with our breaking market coverage at this hour. The Dow crashing yet again today, down more than 2,100, almost 2,200 points right now, despite major emergency action from the Fed as corona cases in the U.S. grow and cities and states start to shut down businesses. And the big banks are getting crushed today, the worst performing sector of all today. Take a look at these here, Valley, Regions, PNC. PNC, and KeyCorp. Citi with the most international exposure, down about 18%. Regional banks, there you see them not being spared. We're going to talk to the CEO of Valley National, which is falling double digits, as you see right there, 12%. He'll be with us, Kelly, later this hour.
All right, Tyler, thanks. And here's what you need to know, everybody. There are now 3,800 cases of coronavirus confirmed in the U.S. New York, New Jersey, and Connecticut are banning all gatherings over 50 people. They're closing dine-in restaurants and bars following that recommendation from the CDC. Finally, U.S. airlines are seeking $50 billion in government assistance, and if approved, it would be the industry's first broad bailout since after the September 11th attacks. And we've got full team coverage of this market sell-off this afternoon. Bob Bassani is monitoring conditions at the New York Stock Exchange. Rick Santelli is out at the CME watching the bond market. Steve Leisman is all over the response from the Federal Reserve. Bob, we'll begin with you.
Third trading halt in the last 6 trading sessions, Kelly. That's this morning, right after the open, 9:30 or so, 15 minutes, the S&P down 7%. These trading halts have at least served to slow the markets down a little bit and do put a little bit of brake on things. We didn't stop us from dropping down about 10%. You can see off of that, 24.09 was the low for the day. We'll keep an eye on that. We are continuing to see this bifurcation in the market. This happened about Thursday last week. It's even more noticeable today. You see banks, tech, and industrial cyclical groups generally underperforming the market, where defensive groups like healthcare and consumer staples generally outperforming. This has been the trend ever since roughly Thursday here. Market gainers here, if you look at some of them, consumer groups largely. Rite Aid, for example, says they're working with the White House to offer testing in car parking lots. Kroger's been doing great recently, understandably. Clorox just got an upgrade from JP Morgan. Campbell Soup, another consumer name that's also been holding up very well for understandable reasons. Some are calling for a trading holiday. We ought to stop for a few days or a few weeks. Stacey Cunningham at the NYSE says no, and she's one of many people in the business calling not to close the markets. It's important for the markets to remain open, she tweets this afternoon, and for them to function in a fair and orderly manner as they have been. Of course, that's been a big debate down here. She says closing the markets would not change the underlying causes of the market decline, would remove transparency into investor sentiment, and reduce investors' access to their money. This would only further compound the current market anxiety. Mr. Mnuchin, the Treasury Secretary, reiterated that on Friday. He, too, is opposed to closing the markets. Finally, just note, here's the new normal. As I walked in this morning, this is what I saw at the NYSE. People coming up to us, checking our temperature. If we worked on the floor, fill out a questionnaire. You feeling okay? Got a fever? You've been outside the United States recently? This is what the world looks like now. Guys, back to you.
All right, Bob, thank you very much. Yields have been dropping sharply again today, and Rick Santelli is all over the action at the CME. Hi, Rick.
Hi, Tyler. Yes, we had 4 sessions where both the dollar and interest rates were higher. Well, looks like we're going to break on both of those. If you look at 10-year note yields on this chart, you can see we're visiting the low end of today's range as we hover around 73 basis points. A month-to-date chart gives you all the info you need. Minus 54 is the low close from a week ago. The low intraday yield on the 9th of March was minus 31. You want to keep those 2 numbers in mind. The yield curve is flattening. We've lost almost 9 basis points today, 10s to 2s, most of that at behest of the long end. So you really pay close attention. As for what's going on in high yield, well, we have a surrogate for that. Let's look at the HYG. Right now, it's at the lowest yield since February 2016. Zoom, 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 all the way back to the March 2008, of course, the credit crisis. That is the definitive historic marker for that. And, of course, these spreads on HYG are wider, but investment grade is behaving rather well, all things considered. Hey, the dollar index is actually up a little on the year, about 1.4%. Let's look at the component parts. Euro versus the dollar, down a bit. That's a year-to-date chart. And finally, the dollar-yen. Dollar definitely down a bit. It's settled at 108.60. It's hovering right now around 105 3/4. So losing some ground on that safe harbor trade. Kelly, back to you.
Okay, Rick, thanks very much. Rick Santelli. Now, the Federal Reserve cut rates to zero with an emergency move yesterday and launched a $700 billion stimulus plan meant to help the market, but it's really spooked investors over how bad things could get for the U.S. economy. Steve Leisman has those details and more for us. Steve.
Kelly, thanks very much. I've been trying to gauge all day, talking to senior bankers at different firms all day, the response to the Fed's emergency actions last night, and the answers are not good. The best thing I heard was it will work, it will take time. But I asked somebody else, they said, is anything better today in terms of being narrower in spread? And the answer was no. Let me tell you some of the issues about the markets remaining on edge. Point number one I've heard out there, some U.S. funding markets still not functioning smoothly. That led the Fed to do an unscheduled $500 billion overnight repo, a second one during the day. There wasn't much take up on that, which may be good news compared to the morning where they took down 129 billion. The afternoon they took down only 19. Huge submissions for these Fed Treasury purchases. As we described all day, the Fed is in the market during the day in a series of purchases of $40 billion of Treasuries and mortgage-backed securities. But the market continues to call for the Fed to do more. We're hearing repeated calls for the Fed to get involved in the commercial paper market and other directed lending that needs to be done, perhaps to certain industries. One of the things that we can tell you guys is the outlook for the U.S. economy now has changed dramatically. We did a Fed survey over the weekend. Now there is a 67% probability of a recession in the next 12 months, and that is up from a 41% already elevated in January. That is the highest probability we've had in the 10 years we've been asking this question. Now, I want to walk you through the outlook for the 40 respondents for growth by quarter. And what you see is a modest first quarter, not really a big hit in the first quarter, but now look at the second quarter where you have a big negative there of minus 1.8% on an annualized basis, going flat in the third quarter, and then finally you get a rebound in the fourth quarter. This is upon available information. And now I hate to provide even more news, but the forecasters at the UCLA Anderson forecasting shop there, they just put out a release saying the U.S. may already be in recession right now, according to their gauge of the economic data. Kelly?
Steve, I have one follow-up question for you. So the Fed today said it was going to do about $500 billion of repo, that kind of emergency liquidity or funding. Then came the news that they accepted just $19 billion worth of bids. So they offered $500 billion and only $19 billion of it was taken up. I mean, what does that tell us?
Well, let me go back, because, you know, that was the second offering. So they actually offered $1 trillion in repo today, as you know.
Wow.
And in the morning, they took up 129. So I wouldn't get hung up on the 500 billion number. 500 billion is a Fed proxy for infinity offering.
Okay.
We will offer you as much as you need. That's the way to think about 500 billion. They don't mean 500. They don't know if 500 is needed. 500 is their gauge of the most ever that the market could need, so that there's as much ample supply for the repo market as may be needed. So the 19 is a good sign. It is not a good sign the Fed felt a need to come in with a second repo action or auction today. But it may be a good sign that in the afternoon they only took down 19 billion. We're going to have to watch these markets. You're going to have to be on the phone talking to people who are saying, look, some of these markets are broken. And in the way to think about what the Fed did last night, Kelly, is really focused on getting these markets to work, because at the end of the day, nothing really matters if the U.S. dollar funding markets aren't working.
No, great info, Steve. We appreciate it. Thank you so much, sir.
Alrighty, stocks are plunging today despite the Fed's drastic action that Steve just described. The market on track for its worst month since October of 1987. For more, let's bring in Mark Lucchini, Chief Investment Strategist at Janney Montgomery Scott, and Victoria Fernandez. She is Chief Market Strategist at Crossmark Global Investments. Mark, on Friday, or you characterized Friday bounce as powerful but impetuous. Its legitimacy will be tested, you said. You were right. This is a test of its legitimacy.
Well, it sure is. In fact, we're basically giving back the gains that were made on Friday, and we haven't even closed yet for the day. So obviously it's disappointing to see that. It would have been nice to see if we could have some carry through into this week, albeit perhaps not as sizable, but nonetheless at least holding its own, particularly with the Fed intervening the way it did yesterday. But the fact is there's a bull market in uncertainty at the moment, Tyler, and until we have some handle around when the number of cases is going to at least begin to decelerate, the market's going to continue to search for a bottom, and we're going to have to live with these bouts of volatility for good or for bad. Now, the market is tremendously oversold at this juncture, which implies we could, on any day or hour, see a rather significant ricochet rally. But again, its legitimacy will be challenged by way of any kind of persistent follow-through, unless, of course, we get confirmation, even perhaps starting in Italy, that the number of new cases being reported begins to subside.
That's a good question, Victoria, because obviously there's a monetary stimulus in the system now. There is at least some fiscal stimulus coming in the form of the package that was moved through the House on Friday night. But it would seem to me that you don't get a market to turn around on just those two things, though they can be very helpful. In this particular and peculiar case, you need to see some progress on the health front before people have any confidence to go out and buy new cars and do anything other than go to the grocery store and load up on staples and paper goods.
No, you're exactly right, Tyler. I mean, the Fed is not here to solve the health crisis, right? The Fed is here to ensure that the markets are functioning properly. So the injection of liquidity that they did is exactly what's needed. We saw illiquidity on our trading desk this morning as we were trying to address some of those measures. But we really need to see here in the U.S. when these cases get to that peak number. Once we see the cases peak, once we see those cases then start to decline, some of the fear and the panic that we're seeing in the markets will begin to subside. At that point, things that the Fed has done will come into play more and allow it to be maybe a stronger recovery than we would have had otherwise. But we're not going to see the markets stabilize until the health issues and that peak number of cases is reached.
You know, Mark, the Dow has lost roughly a third of its value. The Russell has lost more than that. Can you envision a situation where it loses another third of its value?
Well, Tyler, obviously in this environment, anything is possible. However, you mentioned a third, and that happens to be roughly what we typically see in the drawdown in the equity market in or coincident with a recession. So in my view, at this point, equities are presenting a compression in valuation and price that largely have pulled forward the odds of a recession, which are increasing, as Steve, of course, talked about, and seems likely we're going to have at least one negative quarterly print, if not successive. And so I think perhaps while we still could see lower levels from where we're trading today, I think investors should be at least beginning to leg into certain very high quality franchises that have been sold off indiscriminately in this environment, because I think 12 months hence, they'll find it to have been very rewarding.
Begin to leg in. That suggests do it gradually, kind of dollar cost averaging your way in, because you'll never hit the bottom, right, Mark?
Most definitely. And like I said, I can't say for certain that we've bottomed, but we may be at least bottoming, or at least the process thereof. And as a consequence, I think it's very difficult to go in all in and, you know, shoot your ammunition when there may be even a better opportunity that lies in ahead in the forthcoming days or weeks.
Are you starting to nibble, Victoria, or not?
You know, we did start to do that towards the end of last week. I think you can find some opportunities in this market of names that are strong names. They have strong balance sheets. You know that they're going to be able to ride through this, and this would be a good opportunity to start adding to your portfolio. We did it with some existing names like Apple, Amazon, Microsoft. Those are all names we added to and actually brought in new names. ServiceNow is a name that we just brought in our equity portfolio. It's cloud reporting, and we know that with companies moving more and more towards people working at home, and this is a great test of that for companies around the globe, we're going to see more opportunities there. So look for companies that could not necessarily take advantage of the moves in the market that's going on right now, but that potentially will come back and be stronger.
All right, folks, we have to leave it there. Mark Lucchini of Janney Montgomery Scott, Victoria Fernandez of Crossmark, we thank you. Kelly.
Now, today's sell-off is triggering circuit breakers again this morning, freezing trade for 15 minutes. And that makes it the third system-wide trading halt so far this month. It has been a wild March for the markets, with 7 days of 1,000-plus point Dow moves so far. Joining me now to make sense of it all is Terry Duffy. He is the chairman and CEO of the CME Group. And Terry, you know, Rick's not down there on the floor. You guys closed that up a couple of days ago. And as we continue to see everything from gold to Bitcoin to copper under pressure today, what do policymakers need to know about this market action?
Well, I think policymakers need to know a few things, and I think we need to have coordination, Kelly. I know that a lot of people are saying maybe the market should shut down, so let's talk about that for 30 seconds or less. What's important is you don't know if you're going to have pent-up demand for buying or pent-up demand for selling once that comes off. Everybody has said on this show, and they've said it historically, we don't know what the numbers are going to be, so it's really difficult to predict. So what I think would make really good sense is to have the marketplaces tighten up its circuit breakers. Today, as you know, it's 5% overnight. and then it goes 7, 13, 20, and after 20, you're halted. I think we should go 7, 13, and halt.
Wow.
Either that or we should go 7, 10 and halt. But in order, we should not close the marketplaces because we don't know what's going to happen.
Terry.
So I'm not talking my own book. I am actually thinking that we tighten it up a little bit.
Sure. Before we even continue, let me just stop you on this thought. Why? So why these circuit breakers were instituted several years ago? What is it about the trading behavior today that tells you we shouldn't let markets go that 13% or that 20% down in one session? Certainly. Are you basically saying the liquidity has gotten so bad that the circuit breakers need to be tightened up?
No, Kelly. Not saying that. We are dealing with something we have never seen before. We're not dealing with the financial crisis as you and your guests continue to talk about. We're dealing with something completely unknown. And when you deal with unknowns, you should look to tighten it up to make sure that the public has an ability to manage their risk, but at the same time not let their risk run wild. So that's the reason I'm saying that. Not because of illiquidity. We're doing $1 trillion a day in notional and E-mini S&Ps every single day. It's not the liquidity, Kelly.
So here's what I'm trying to understand. What would tightening that up accomplish if you're saying, look, we don't want to close things. We want to make sure that people are, if it wouldn't accomplish anything, why do it then?
Kelly, it would accomplish a couple things.
Okay.
You have a lot of people, including Scott Wapner, who works for CNBC, tweeting that the market should be closed. My point is that would be wrong to close the marketplace. There's a lot of people in Washington don't know what to do. They think maybe should they close the marketplace. That's wrong. What you should do is just tighten up the bands for now during this very stressful period, but yet don't close them. And then also, you have ETFs, Kelly, as you know, that are trading outside of these bands that are becoming leading indicators. How is this even possible? Do not be in coordination with the overall equity market. So, Kelly, what I am suggesting is that we all be in coordination, but we might just need to tighten this up a little bit to take a little bit of the volatility out of the overall market, not shut them down, tamper the volatility.
Now, that's an interesting point, too. So we've all taken to watching the Dow, the S&P, the QQQ ETFs to the NASDAQ as a proxy for, hey, if the markets were open, this morning was a great example. I'm looking at futures halted and saying, okay, I get it. They're halted down. I think it is 5%, but the Dow would be down 11% right now. And I can see that because that ETF trades as of 4 a.m. Are you saying that in order to make sure that, what's the point, effectively, we should not allow for those ETFs to trade and kind of give us the information anyway, kind of undermines the point of having the futures halted, or not halted, but again, price limited.
You got to coordinate with the underlying securities markets, futures markets, and other things. You cannot have the ETFs, which are highly illiquid, determining what the overall multi-trillion-dollar U.S. equity market is going to do. That's my point.
So, Terry, let me get this straight. So you're saying there is no, so I'm sort of thinking about it from policymakers' point of view here, there is no liquidity problem. You're saying you're seeing a ton of action in terms of people showing up to trade, price discovery, it's working. But you're saying for the general public that, maybe a way of taking some of the pressure out of and the volatility out of this situation is just by having trading halted if we hit something like 13% instead of 20%.
That's all I'm saying, sir. I am saying that don't close down the markets because you don't know what's going to happen when you reopen them. Everybody thinks that the waters will be calm and will open straight up. I mean, maybe that is the case, but it's a very big risk to take. And because there's so much money being managed passively versus actively, you don't know if you're going to hit a massive amount of stops with all this passive money sitting in the market that hasn't even transacted yet in the overall market. They have different levels. They're not actively managing their portfolios like they used to. So I don't know what the case is, but I do know one thing. You should at least leave the markets open so people can transact, but at the same time, be responsible about it during a time of crisis. This is not 08, Kelly, as everybody is saying. This is a virus of which you, me, and everybody else knows nothing about. We're not MDs, and we should let the professionals tell us what to do. And at the same time, we should at least think about coming up with some new solutions so people can transact business.
Yeah. All right, Terry, thank you. Thanks for joining us today.
Thanks,
Terry
Kelly.
Duffy,
Appreciate it.
CEO of the CME Group.
Well, the airlines are under pressure as more global travel bans are put into place and demand drops sharply for domestic flights. Let's go to Phil LeBeau for the latest details. Hi, Phil.
Tyler, there is no indication when demand will rebound and when people will start booking flights as opposed to canceling them. As you take a look at the major U.S. airlines today, most of these stocks are off of the low of the day. Now, they did come back about an hour ago when the industry's trade association says, look, we're looking for an aid package out of Washington of between $50 and $58 billion. No indication whether or not that is going to be received enthusiastically on Capitol Hill or whether or not this is just the beginning of a negotiation. When you look at specific stocks, take a look at United Airlines. And the reason we're showing you United is because last night they said we're going to cut our capacity by 50%. But it was the message from CEO Oscar Munoz that really stood out. He was very blunt. He said, the worst is yet to come. We do not see this getting better. Day by day, it continues to get worse in terms of demand. And it's not just here in the U.S., by the way. As you look at international carriers, especially those in Europe, take a look at Ryanair. They're talking about grounding the majority of their fleet within the next week. And that's because you've got a number of countries over there, whether it's Poland, whether it's the Ukraine, etc. They are saying we're not taking in flights from outside the country's borders. As a result, an airline like Ryanair is looking at grounding its fleet. And also Virgin Atlantic, which is 49% owned by Delta, Virgin Atlantic is suggesting that it may be giving unpaid leave for up to 8 weeks to many of its staff members. So guys, we're in the midst of seeing the airlines trying to come up with two things. One, a way for their governments to help them out through this crisis. And two, whether or not they have to look at cost cuts or furloughs.
Offered 8 weeks of unpaid leave. That doesn't sound like much of an offer to me, Phil, to be honest with you.
No, but what's your alternative? Okay, well, we don't need you anymore. We're going to furlough you or we're going to lay you off. I mean, it's a tough choice if you're an employee.
It basically is an 8-week furlough.
Sure.
But so what other measures are you seeing airlines take to combat what's been going on with the virus?
Sure. Well, I think one of the more interesting things is that the airlines are trying to convince those who are still flying that, look, when you get on a plane, and we've seen all of these reports of, well, it's not safe to get on a plane, coronavirus is floating around, they don't wipe down these planes. Look what Delta does. Delta has hired a company out of Boston. It's called Earth Safe Chemical Alternatives, and they essentially spray a chemical that it's a disinfectant on the aircraft. And we talked with one of the executives with the company earlier today in the parking lot at CNBC. He gave us a demonstration, and he basically explained how this works.
One of the benefits of this technology is how fast it can actually disinfect an airplane. It takes just 3 to 4 minutes from start to finish. The chemical requires just 1 minute contact time to kill coronavirus effectively. And the benefit there is that they can use it to disinfect the planes not only in the evenings, but also between every turn. And it takes just minutes until the passengers can reboard the airplane.
Perhaps one of the more interesting things is that when we first reached out to this company, Tyler, our producer Megan Reeder reached out to them. They were like, well, we're not really sure people want to talk about this. Now the airlines and other companies are saying, yeah, we want to let the public know that we are disinfecting not only aircraft cabins, but other companies that are using this technology.
Fascinating stuff. Phil, thank you very much. Phil LeBeau.
Well, the Federal Reserve took some drastic emergency steps last night. Hasn't done much to calm markets today. The stocks are down about 10%. Lows. Dow is down about 2,800 points. We're not back there quite yet, but we are still down more than 2,000 points at this hour. The Russell 2000s are down nearly 12.5%. And the last time the Fed kept rates at zero, says my next guest, the policy failed. He fears coronavirus shutdown in the U.S. Could tip off a second Great Depression. Joining me on the phone is Chris Rupke. He's chief financial economist at MUFG Union Bank. Well, Chris, as pessimistic as they always say the bond guys are, listen, you know, we were just speaking about an hour ago to Torsten Slok about whether we're going to see maybe 3 months or 6 months or 7 months of negative GDP. You seem to be talking about something quite worse than that. What do you see?
Well, I may have engaged in a little hyperbole, but yeah, the world's running that way at the moment. I'm shocked that some of my colleagues on Wall Street are already calling for real GDP to fall 5%. 5 percentage points in the second quarter. It shows you how extreme this has gotten. So put it this way, if growth this quarter, we're not even going to get growth until April for the first quarter. If growth is unchanged this quarter, down 5% in the second quarter, up 1%, third, up 2% the fourth, then GDP will fall this year 0.5%, as the Fed measures it. And looking back to the 80s, it's only fallen 2 other years.